In New York City, I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief, the ultimate guide to help investors make smarter decisions for their portfolio. We are tracking early session volume while bringing you today's top market themes and elevating Yahoo Finance's most popular newsletter.
That's right. We've got a busy show for you today. U.S. markets powering to new records. The S&P 500 futures extending some gains here as we're coming off of another record close. It's third in a row.
And a big reason for the green that you're seeing on the screen is tech earnings. You've got Netflix shares soaring in the pre-market after reporting a massive beat for the fourth quarter. And Dutch chipmaker ASML, a bellwether for the industry's health here, reporting that orders tripled. So let's get right to it with the three things that you need to know, your roadmap for the trading day. Yahoo Finance's Jared Blickery, Alexandra Canal, and Josh Lipton have more.
That's right. The S&P 500 notches a third straight record all-time high. Big cap tech behind the market's momentum, but the broadening hasn't quite materialized yet. We're going to break down why this rally just won't quit.
Netflix shares rallying today, up double digits in pre-market trading after the streaming giant reported strong growth numbers in the fourth quarter, adding 13 million new subscribers and giving guidance for Q1 that exceeded the street's expectations. Here's what Netflix CFO Spencer Newman had to say on the company's earnings call.
We expect continued member growth powered by a great slate, including the full year impact of our 2023 net adds carrying into 24.
But not everyone is as bullish as Newman. We'll talk to one Netflix analyst who's advising investors to stay on the sidelines for now.
And former President Donald Trump sweeping the New Hampshire primary Tuesday, winning with nearly 55% of the vote, bringing the nation a step closer now to a rematch between President Biden and Trump later this year. We're going to break down which companies could benefit from a second Trump presidential term.
Well, today's top story, futures extending gains this morning as tech stocks continue to propel this rally that we've seen. ASML, Netflix, they are leading the charge as their earnings topped expectations. ASML, they produce a lithography machine that is vital to the manufacturing of advanced chips. Now, the company reporting a 30% jump in its full year revenue, another optimistic signal for the semiconductor space. You're taking a look at shares here pre-market up by about 6%. It contributes to even more of the AI chip demand and strength that we've seen propelling the markets thus far, Shauna.
Yeah, certainly all eyes are on tech, and it's not just because of some of the results that we're getting here ahead of the bell, also what we heard from Netflix last night, but also what we've got after the bell here. We're going to bring that to you on Yahoo Finance, but we'll hear from Tesla and IBM. So certainly the focus for the day is on a lot of these tech names. And you take a look at some of the movement more specifically of what we're seeing in ASML. Now, this is a stock that we don't necessarily, it's not a household name. Some of you might not be too familiar with it, but we bring this up. And the reason that we're seeing such a move here is because of the degree of demand that we are seeing for their products and what that points to in terms of a recovery for the chip makers, also on the heels of what we heard last week from Taiwan Semiconductors, right? Certainly a rebound that we're seeing maybe within the sector. So certainly what this then potentially signals for other big players within the chip space.
If you're not talking about lithography at the kitchen table, what are you even talking about at the end of the day here? This is essentially a projection system here where they are using this process and repeating it over and over again to be able to make patterns that go on top of these chips here. And so what they essentially do in ASML, they're the ones that are able to produce these lithography systems, sell them as whole units here. And in this most recent quarter, they actually sold 105 of those 113 of them, the new ones in the third quarter. And then they're also able to resell some of the used ones. And so these systems, essentially, they're able to kind of look across some of the latest extreme ultraviolet printing and deep ultraviolet printing to kind of create different layers that are needing to go on top of the chip in a nanometer type technology capacity. So ultimately here, super clean rooms, super clean factories that they got to produce these in. And you should be talking about lithography more at home.
Maybe we will. We're going to make it a household name. The first day that we're trying to do that. All right, shares up just about 6% here ahead of the market. Well, let's get to Netflix because this is a stock that is likely on your radar here. And you got shares jumping ahead of the open, up just about 10%. Now the move higher coming after the company company added over 13 million subscribers in the fourth quarter, also gave guidance for the first quarter that exceeded the street's expectations. Now, Netflix recently announcing a deal just yesterday in the sports space with the WWE, a strategy that executives called close to its core in the earnings call last night.
And now with this great storytelling, with the events itself are the storytelling of the WWE. So this is a proven formula for us that we're excited to jump into. This is sports entertainment, very close to our core. The deal's long term. We're super excited about it.
So Sarando is very excited about what this could mean, but despite all of this and the excitement, the optimism, our next guest maintaining his neutral rating on the stock. Let's talk about it. We want to bring in Jason Bazinet. He's Citi's managing director, joining us now. So Jason, it seems like Netflix is almost firing on all cylinders. An extremely strong quarter here for the company. Lots to be excited about, especially when you tie in the recent deal that they have with WWE. Why are you staying on the sidelines?
Well, our neutral rating had three elements to it. We were a little bit nervous about the fourth quarter revenues of this year. We'll see if that's still true, given this very strong number. The second one is we think content spending has to go up next year. And they were explicitly asked on the call if they should sort of step off the accelerator on content spend, generate more free cash. And they said, absolutely not. We want to spend more as long as we continue to grow. So I think that part of our thesis is still intact. The third element of our downgrade was really the potential that they do M&A. And it was very interesting on the call yesterday, the CFO mentioned for the first time that they're sort of under-levered relative to their ideal capital structure. So it sort of hints to financial firepower to go potentially do a deal above and beyond the $7 billion of cash that they have on the balance sheet.
What is the characteristic of a deal that would make sense for them to do?
Well, they've dabbled, of course, in mobile games.
Sure.
They've also spoken publicly about the lack of intellectual property that exists within Netflix. Mm-hmm. So we've always thought a AAA game publisher like a Take-Two that has strong IP like GTA and has a big, strong mobile portfolio with Zynga would make a lot of sense because you'd kill two birds with one stone. You'd get the mobile games and you'd get the IP.
Jason, when it comes to the fact that, and we heard from the executives in the call, that they're not interested in linear assets, not exactly a massive surprise there. But when you talk about maybe some of the pressure that the stock could face if they don't live up to some of these expectations or the guidance or what some of your colleagues on the street are looking for, what do you think that downside risk then could look like here for Netflix if they do continue to spend at a higher rate than maybe what's being priced in?
Yeah, the street goes back and forth. Sometimes they look at earnings, sometimes they look at cash flow. I mean, the most common framing that I hear is sort of if you sort of rolled forward 1 year and you had $20 of earnings, some investors say, well, I'd put a 20 multiple on that if things falter, and that would get you 400. Other investors say, well, $20 a share, I'd pay a 30 multiple for that, and then you get 600 a share. And so you can sort of see at 540 where we are today, it doesn't strike me as particularly compelling.
Jason, when you talk about that free cash flow, some of it seems like it's going to come back to the pricing power here. And they did acknowledge this on the call last night. We do have a brief clip of them talking about where some of those fees could move a little bit higher or moderate higher for customers. Let's take a listen real quick.
We will continue to then monitor other countries and try and assess, when we've delivered enough additional entertainment value. We look at engagement, retention, acquisition as the signals there, so that we can go back to members and ask them to pay a bit more to keep that positive flywheel going. And we can invest in more great film series and games for those members.
So what type of pricing power from this point would you need to see from Netflix in order to change your type of positioning currently on it?
Yeah, I don't have any qualms with sort of the value consumers are getting with the level of engagement. So I think we'll probably see mid-single-digit pricing growth across all of the countries on average.
How does that translate into some of the subscriber growth as well? Do you believe that kind of moderates lower in terms of the year-over-year percentage, or kind of stays the same?
Yeah, so our forecast has about 10% top-line growth. So it's about 5 units of volume, 5 units of price to get to the 10% growth. The reason the stock is reacting so positively is the real debate among the buy side is not so much whether they have pricing power. The real question is, what is the magnitude and duration of the two main subscriber growth metrics, which is the ad tier crackdown, password sharing crackdown, and the ad tier, right? And so when they guide to sort of 8 or 9 million subs and they do 13, that's telling the market, hey, this has a lot more legs to it, could be higher magnitude than we thought. And so that's where the real debate is, net ads, not pricing.
Jason, where do you think Netflix falls when we talk about the streaming wars that are ongoing right now? Lots of talk about consolidation, what exactly that's going to look like, what Netflix needs to do in order to remain on top. Where do you think they lie right now, given everything that you've been saying, valuation, stock performance recently, compared to some of the rivals?
Well, Netflix won. I mean, you know, when the stock was 200.
Is there any threat to Netflix when we talk about anyone that could really challenge them here?
I don't think a real threat to Netflix. I mean, we're sort of still maybe a third of the way through the transition from linear television to streaming. So there's plenty of runway for them to go. So I don't really think of it more as a competitive threat. I think it's more about the incumbent media companies actually generating profits in their streaming efforts. Right now, they're all generating losses, right? That's what makes Netflix special.
I mean, well, you have Nelson Peltz and Tryon initiating and following through on an activist campaign saying they're targeting to achieve Netflix-like margins of 15 to 20% by fiscal year 2027. Is Disney going to be able to get to the same type of margin profile on its streaming as Netflix is currently seeing right now?
Yeah, the former CFO of Disney used to talk about 20% EBIT margins being sort of the long-term target. So that's a bit below. Netflix is talking about 24% EBIT margins this year. So I think moving in the right direction, you know, but maybe not to Netflix level if you don't have that level of scale. One of the things that I think is so interesting about Disney, where we are buy rated, is I have not had one person on the institutional investor base ask me what Disney's EBIT margins could be. The entire narrative is losses getting to break even, and that's going to happen this year. But no one's asked what happens next, right? Peltz is asking it. You know, we're thinking about it. The stock certainly doesn't reflect it.
What do you think is next?
Well, I think I'm going to start getting inbound questions from investors saying, well, why couldn't they do 5% margins? Why not 10% margins? Because Disney is an earnings story. So if you're generating no EBIT from streaming, implicitly the street is paying nothing for Disney's streaming business. That's just wrong.
Jason, we could talk about this all day with you. Jason Bazinet, who is the City Managing Director. We know you got to get back to some of those client calls as well. Thanks so much, Jason.
Thanks for the time. Yeah, you bet.
Well, former President Donald Trump winning the New Hampshire primary Tuesday with nearly 55% of the vote, bringing the nation a step closer to a rematch between President Biden and former President Trump later this year. A second Trump presidential term could bring the U.S. back into an era of protectionism. And if that were the case, domestic steel, aluminum, and lumber companies might win big. For more on this, we turn to Brian Gardner, who's the Stifel Chief Washington Policy Strategist and Yahoo Finance columnist. Rick Newman, great to have you both here with us today. Rick and Brian, as we're kind of continuing to evaluate this, one of the larger overhangs is the fact that even in international policy previously, we still haven't had some of those purchase agreements be followed through on now, whether that's because of the pandemic that ensued, in the timing leading up to the election, all of these things. There is still a larger question of what would be the U.S.'s stance internationally here. And Brian, I'll go to you first on this.
Sure. So, you know, if it is Donald Trump who wins the 2024 election, then, you know, I think the platform is pretty clear that that they are going, that a Trump administration would go forward on expanding the tariffs. And I think enforcement of the tariff mechanisms would become more of a focal point, whether it was because of the pandemic, whether the Biden administration was preoccupied with other matters. The follow through on those agreements going back to the Trump 1.0 administration hasn't been robust. So I think you're going to see a much more aggressive follow through on previous agreements and really stepping them up, not just vis-a-vis China, but across the rest of the world.
Brian, do you think Trump is at this point pretty much a sure bet here for the GOP nomination?
Oh, the party's over. You know, turn out the light. The party's over. It is done. It really was finished back in the spring. The moment that the Manhattan DA walked out with the first prosecution, I think you can, especially in retrospect, but we can say that the GOP race ended on that day. They went through the machinations, but it was over then.
Rick, do you agree with what Brian's saying? And I think also just taking it a step further, do you see the GOP party rallying behind a Trump nomination?
Right. Yeah, Brian's right. Unless there is a health issue with Trump, he will be the nominee. And I think he will be the nominee even if he is convicted in one of these trials that's underway. It's not clear we'll even get to a trial by the time of the convention over the summer or even election day. But I think as Brian pointed out, he becomes more popular with Republicans through all these prosecutions. There were some warning signs for Trump, though, in New Hampshire, which point to some things that are going to come up in the general election. He lost independents in New Hampshire by almost a 2-to-1 ratio. And independents, particularly in about 6 or 7 swing states, are crucial voters. Now, they voted for Nikki Haley for the most part last night. That does not automatically mean that Joe Biden would get those voters in a Trump-Biden rematch. So this is kind of a familiar problem for Trump, which is that he has devotional support among his base, but he has very shaky support among independents, suburban women and voters like that, who are pretty likely to decide the race. So the whole question, similar to in 2020, is Trump's base enough to put him over the top? And that's very much an open question.
Brian, layered onto that, you had a lot of Wall Street power that was thrown behind Nikki Haley. Does that automatically shift over to Trump? Or if he is convicted on any of these cases on the criminal front, do some of the Wall Street dollars, donors, the super PACs, do they say, okay, we're going to prioritize perhaps maybe not voting for Biden, but put some of the money towards other down ballot campaigns that are being run to make sure that there's still logjam in Washington?
It's a great question. I don't think you can paint with too broad of a brush. A lot of kind of Republican money, Wall Street money, will go to Trump for now. If there is a conviction, and I totally agree with Rick, I'm very skeptical we're going to get a conviction before the election. The timing is just too complicated, and that's a separate conversation. But if there were, in that hypothetical, there were to be a conviction, then sure, there'll be some hedging of bets, shifting money to down ballot races, maybe just holding back to, dry powder, see how it plays out after a conviction to see what happens next, and maybe shift back to Trump after that. Maybe they decide that that voters are still behind him and that he has a chance and that they're going to want a seat at the table come January of 2025. So, I think, yes, in the short term, you'll see a shift over to Trump. It's already happening. Longer term, if there is a conviction, maybe keep the powder dry and then deploy it depending on how the situation evolves.
Rick, guys, I would add to that. I don't take for granted that Trump would necessarily be better for markets. So just to get into the details a wee bit, Trump does want to impose 10% tariffs on virtually all imports, and he wants to decouple the U.S. economy from China, not just fend off the U.S. economy in certain areas, which Biden has done, such as semiconductors, electric vehicle components and stuff like that. Trump wants to decouple the U.S. economy from China. Now, who knows how far he would go, but despite everything that's happened with regard to China, we still do a ton of trade with China, and trade both directions, imports and exports, is almost at the highest levels it's ever been with China. Big changes on taxes are coming too, but I don't automatically assume that Trump would be better for the markets than Biden.
All right.
I think just one quick. I think there's a trade the day after the election, but I agree with Rick. Longer term, that natural reaction that Trump would be better for the markets. I think investors are going to have a lot to absorb if Trump is elected. Not just the day after, but going forward after that.
Yeah, certainly breaking down the policies, exactly where it's going to impact, and not to mention some of the movement that we've seen in some of those meme stock plays too, as it looks like Trump will solidify his lead there as the GOP nomination here as we count down to the election. All right, Brian Gardner, always great to have you, and of course, Rick Newman, thanks so much for taking the time, guys.
Yep.
All right, keep right here on Yahoo Finance's Morning Brief. Much more of today's top trending tickers when we come back.
Time for some trending tickers that we're watching this morning. Let's begin with AT&T. Shares, they are lower this morning by about 2.7% after the company gave full-year guidance for adjusted earnings of $2.15 to $2.25. That's below the street's expectations of $2.44. But the company did post growth in its mobile phone subscribers that's exceeded forecasts here. A lot of numbers to really dive through. You were able to kind of get some of the themes as well with the company and the top brass over there at AT&T.
Yeah, certainly. I was able to speak with one of their executives there. And my takeaway from this quarter, taking a look at the numbers and kind of putting that into context for everyone, is when you take a look at the mobile side of the business, consumer demand, what exactly we are seeing there still paints a pretty strong picture, an improving picture, you could say, here for AT&T. They're not seeing a huge uptick here in terms of delinquencies. They are seeing pretty much resilient demand. That would prove and point to further strength here going forward. There is, though, this issue that they have embarked on over the last several months, last couple of years here, in terms of this cost-cutting campaign. And I think that's still playing out inside the company. They have cut a number of jobs. They have also eliminated certain assets, closed offices in an effort to better position AT&T here for the future, for that renewed focus here for the stock. They have a ways to go. But on the consumer side of things, when you take a look at some of these numbers, especially on the mobile business, there are 526,000 subscribers added here in the most recent quarter. Obviously, a lot of that driven by holiday spend and some of the promotional activity that we saw, very similar to what we saw play out at Verizon. But again, I think the reaction in the stock, not necessarily a huge surprise, but there are certain nuggets that you could be a bit optimistic about when we talk about the transformation going forward.
And it's also interesting where the investors, the analysts who are tracking this name might be optimistic about what those phone net ads may look like in an era where we're waiting, all of us sitting on the end of our ergonomic chairs, waiting for some of that artificial intelligence to make its way into more handsets and smartphones. And so artificial intelligence layered into the devices that we use, but also into how AT&T operates its business and where they can leverage that.
Yeah, and AT&T really making that clear, right? They're using it in order to cut costs. They're also using it to improve the customer experience. At least from their view, they're saying that their investment in AI technology is not only helping them cut costs in those necessary areas, but they're saying does help consumers. Like we debated, though, in the morning meeting, we're not so sure that we love AI being used with all customer service, but they're right, it does certainly save a ton of money. All right, we're also switching gears here and looking at shares of SAP after announcing a restructuring plan. It's going to impact 8,000 jobs. Now, the company is shifting more of its focus towards artificial intelligence, AI, certainly the buzzword here at the start of 2024 with these tech earnings. So as part of this move, the company is saying its operating profit is going to rise to near $11 billion in the next year. And taking a look at some of these moves, and Brad, I'm going to hand it over to you just because of your experience at SAP, and you were there at a former restructuring here, but it's part of a broader trend, right, of companies pouring more money into AI, they're reallocating their business as a result. They're not necessarily, and they're not eliminating 8,000 jobs. They're looking to reskill some of that workforce and also figure out what makes the most sense as SAP positions themselves better for this next round here of technology.
Yeah, my first employer out of school, and one of the huge things that I remember back then in a previous kind of restructuring or reframing of how this business sees its revenue growing in that next inflection point, that was back when cloud was taking off. And the cloud solutions business back in 2011, 2012, I remember internally the sense of how big an investment, both in reallocation of headcount and in the types of solutions that were actually being put into market, the company was making around some of those advancements in cloud and where it was making strategic acquisitions as well. Remember, a lot of these ERP companies, they abide under the acquire to grow type of mindset or mantra, but for SAP and the internally grown solutions, that's where it's going to be interesting to see where some of this reallocation comes to fruition now in this next inflection point that they're anticipating in artificial intelligence. And, you know, just to put some numbers on this, I mean, the stock back then was trading around $60 a share. Look at it here today. It's trading at about $163 a share right now. So all of these things considered, there's a massive upside that I think the executives are seeing and taking the kind of roadmap approach to say, where do we put people in the right positions in order to see that actually come to life?
Yeah, certainly what they've done in the past has been working given that massive run-up that we've seen over the last several years. All right, when we're talking about jobs being impacted, we also want to take a look at eBay because eBay is actually announcing it will be laying off 1,000 workers. That's equal to about 9% of its full-time workforce. Now, the company's CEO writing in a letter to employees that, quote, expenses have outpaced the growth of the business. This is the second round of layoffs for eBay in the last year. And taking a look at that one-year chart here for the stock, it's off just about 11%, so far underperforming the broader markets here. So no doubt, no surprise, it is a very challenging economic environment. They're being forced to make some of these tough decisions, like reducing headcount. They're looking to also reduce expenses here, obviously, as part of that move here to cut headcount, as that has been, at least in terms of what the CEO was saying, outpacing growth here. Putting this all in perspective, because you and I have been talking a lot about layoffs since the start of the year, specifically what we're seeing in the tech sector. And layoffs.fyi, they were out with some stats here on this, saying eBay joining more than 60 other tech firms announcing layoffs just since the start of this year.
Yeah, I mean, this blog post that they ultimately put out to kind of give some more details around it, which you mentioned, that 1,000 roles, 9% of the full-time employees, but it also even goes into some of the contractor positions, looking at how they're reframing and implementing organizational changes and consolidating certain teams for that end-to-end experience here. For eBay, this is a company that we've seen outlast multiple changes in e-commerce and multiple consumer environments. And so it'll be interesting to see how they navigate a value-conscious, once again, value-conscious consumer environment that tends in times like this to go back towards resale platforms or back to auction platforms to try and get deals wherever they can, even in a deep discounting or promotional environment. One of those environments or realms that some customers go back into is just saying, okay, who else is selling the thing that I have, and I can buy it for perhaps the low or at least mid-tier price.
Yeah.
So.
But it is still, though, tough for them to compete when you have Walmarts out there, Amazon, that are offering those lower prices. They have been losing market share to some of those larger
Bringing
players.
on third parties,
Exactly, yeah. So we certainly have seen a shift there. All right, let's take a look at our stock to watch today, and that is Texas Instruments. Now, the chip maker giving weak quarterly guidance. You're seeing that reflected in the share price here just ahead of the open. Madison Mills standing by on the floor of the New York Stock Exchange with the latest on that for us. Maddie.
The first of many in the chip sector that's going to be reporting earnings this cycle. And that's why this is our stock to watch this morning, because TI can be considered a bellwether for the broader space. We've got a miss on EPS and a miss on revenue, with sales down by a whopping 13% for Texas Instruments. Now, I just want to point out that, yes, we're saying things like chips here, but this is an analog chips maker. This is not your AI chips play that you're going to see in an AMD and an NVIDIA. This is the chip that allows you to press a button on your calculator and run some calculation. A little bit triggering for me of calculus class back in high school, but that's what their chips business is really about. But they also produce chips across a variety of sectors. It's industries, it's autos, and that's again why this is a bellwether for the broader space, because they're seeing a decline in demand across multiple sectors, and that is not going to be good news. That's one of the reasons why we saw this being the most shorted chips move in the latter half of 2023, and of course it's trailing the broader SOX index this year as well. Moving forward, they're investing about $5 billion a year to upgrade their manufacturing so that they can play with those other folks I mentioned, the NVIDIAs of the world, but we'll have to see whether or not that boosts their stock price.
All right, the decibel level just revved up there, Madison. So we're going to come back to you in a moment here. We're standing by for the opening bell on Wall Street, as you heard some claps, cheers in the background at the NYSE. We'll get back to Maddie here. But taking a look at the futures here this morning, and again, we can't stress enough the environments that we're in right now with some of the earnings that are continuing to come out, powering us to some of those new all-time highs for the S&P 500. We'll see if that continues to lock in here today as well. Here's a look at the opening bell on Wall Street.
And there you can see the excitement down on the floor of the New York Stock Exchange. Morgan Stanley Investment Management there ringing the opening bell, and also at the NASDAQ as we cheer what could be another record-setting day for the markets. Again, the S&P and the Dow here pushing higher at the open, as well as the NASDAQ. A lot of the excitement, a lot of the optimism is it because of exactly what Brad was just talking about. The hype and also outperformance that we have seen in so many of these tech earnings, at least so far, specifically what is playing out with Netflix right now, with shares rallying about 10% here at the open. Well, we've got team coverage for you, closely following the market's every move. Madison Mills on the floor of the New York Stock Exchange, and Jared Blickery standing by at the big board for us. Maddie, let me send it over to you first.
Yeah, so I'm hearing a lot of excitement about earnings, right? Of course, excitement about Netflix earnings from last night, still lifting up the NASDAQ in the morning's trade. Just to a quick look at the green that we're seeing across the screen here, even the Russell up 1.10% this morning, the NASDAQ up 0.9%, and the S&P up about 0.5%, and seeing that broadening a little bit. When you think about the outperformance of the Russell this morning compared to those other indices, that could be an indication that we're starting to see some broader bullishness in this market beyond those 7 names. Now, speaking of those names and speaking of the earnings picture, also hearing excitement about what we're going to see from Tesla later today. That earnings call could be the indicator of what's going to lead your trade heading into tomorrow. Also hearing some market commentary on the floor this morning getting talked about, specifically a note from Michael Gapin at Bank of America, reiterating their call for a March cut. We're going to see what the Fed has to say about that next week.
All right, Maddie, thanks so much. Of course, we will be closely watching any developments there ahead of that announcement and, of course, what we get here from the Fed next week. Let's send it over to Jared Blickery. He's here at home base at the Interactive with a closer look at some of this movement here at the Open, Jared.
That's right, more record highs, and we're going to get to some of those in a second. First, let's take a look here. NASDAQ leading the way among the majors, up about 0.8%. Russell 2000 leading a little bit beyond that, up 0.9%. And when you take a look inside the leading sectors of the day, it was communication services before the bell and also after the bell. And not surprisingly, that is a Netflix-influenced sector. Real estate and tech also doing well. Energy in the top 4, but staples and materials, both of those taking a little bit of a downdraft today. Healthcare also flirting around the unchanged. And let's take a look at the NASDAQ 100. We can see the mega caps here really strong. Google, Alphabet up more than 1%. So is Amazon and Alphabet. Apple finally clearing the way. It's in the green as of 2 days for the year. That's up another 0.5% here. And if we take a look at some of the leaders, we can get a better flavor of what's going on. China, another strong day in China. We were talking about that strength and some floating of 2 or 3 trillion yuan facility. Anyway, China looking good, crypto looking good, and not too much trading to the downside here. Just want to leave you with the banking sector as earnings continue to roll in here. A lot of green on the screen and another record high for Berkshire Hathaway. Haven't talked about that much recently.
All right, Jared, we're going to talk about that perhaps a little bit later on. You've put it on our radar, so now we must follow up. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Stocks extending gains at the open as tech and chip makers rally on the heels of solid earnings reports here. Netflix, the biggest gainer in the S&P 500, surging 10%, 11% now higher. Here with more, we've got Keith Bliss, Blockscross Global Head of Markets and Strategy, here with us in studio. Keith, great to see you. I mean, when we think about some of the catalysts that could continue to drive markets, is it as simple as some of these earnings coming in perhaps better than expected, and for what we had seen coming into this week, beating on maybe a core figure, which is margins as well, and going past some of the expectations?
Yeah, certainly in the short term, Brad, that's correct when you look at it. And I tend to look at the market in 3-month chunks of time. Yeah. And try and figure out what's going to be the strategy going that way. And in the first 3 months, certainly we've got 2 Fed meetings in the first 3 months of the calendar year. They're not going to do anything. Hopefully they'll continue to give us a little bit more salve about what the back half of the year is going to be like. So that's a catalyst or a macro issue that I kind of put to the side for the moment. So it is all around the earnings season right now. It's going to be around what the interest rate sensitive cyclical names are saying. We got a good report out of Procter & Gamble the other day and what they said. So that's a company in the staple sector that's saying, yep, the consumer's still strong. They've adjusted to the price increases. But more importantly, what's going to drive the market is the Magnificent Seven rides again and continues to ride. And an old FANG name, Netflix, is technically not in the Magnificent Seven, if you want to say that. They absolutely hit it out of the park with their number, and I'm getting close to saying game, set, match for Netflix on all the other streaming services, because they figured it out. Now they've built these barriers to entry, and either Paramount, Disney, Comcast, all those companies, they start pouring more money into it, which of course their shareholders are saying don't do anymore. Netflix will continue to be the big winner here, and that will continue to drive the market, NASDAQ especially, but then the S&P 500.
Yeah, Keith, we were talking to Jason Bazinet from Citi at the top of the show. He covers Netflix, and he was saying a very similar tune, just in terms of the fact that they are by far the leader in this space. No one near them in terms of who would potentially be able to catch up with them, at least within the streaming space. But going back to what you just said about the Mag 7 names, do you expect to see strength from all 7 of those names? Or I guess, who do you think is really going to show some leadership here this year?
Well, I do think the big tech names, whether you're looking at Alphabet, Amazon, or Microsoft, they have really good core businesses. And believe it or not, the AI trade is still going to be on. And the AI trade is still going to be on because we're still digitizing the world, we're still wiring it up, and the big thing in AI is around cybersecurity. So you just can't perform a proper cybersecurity across your platform unless you're investing in implementing AI quite a lot along those platforms. You'll see individual names, Shauna, around the Magnificent Seven and the old FANG names. Again, Netflix is technically not part of the Mag 7. That will outperform. And then I truly believe you're going to see a name like Tesla really come back. It's at a price level where rumors that I hear in the conversations that I have, everybody's whispering is like, now it's time to catch a bid on that name, and especially if Elon Musk comes back in. He's posturing a little bit with his board right now about things like that, but if he comes back in, he assumes more control. They're going to be the Netflix of the EV market. The problem in the EV market right now is coming out of the big 3 and some of the smaller players. Mm-hmm. People have gotten to the point where they're not buying Tesla because it's an EV. They're buying Tesla because it's a Tesla, and that'll continue that. So I think they'll right the ship a little bit and they'll get back on course. So the Mag 7 will drive the market certainly in the short term, especially as the Fed stays pat and interest rate sensitive stocks are not able to gain traction right now. My main worry, if I may, just one more counterpoint to that, is my main worry is we've got to start broadening out this rally if we want it to make it really sustainable into 25. I don't think 24 is a big deal. There's going to be a macro overlay that's going to help us here. Mm-hmm. But really into 25, we need to see more of those names downstream in the NAS 100, downstream in the S&P 500 really kickstart their earnings and do well.
Is there a bellwether earnings report from your perspective that presents the biggest downside risk to this rally right now?
Currently, I can't see it. The only one that I really would point to, again, in the very near term, Brad, is IBM. IBM reports tonight, and IBM I think is an important story because they go from, we think about what they did 50 years ago, right? Big cabinets sitting on 4 floors inside of a beautiful building like you guys have here. And now 75% of their revenue comes from software and consulting. Right. And one of the big drivers that they're looking at in the consulting business is around consulting companies on their AI implementation. They got a boost in the market yesterday because Taiwan Semiconductor has come out and said that their earnings, they expect to have a 20% year-on-year growth, and a lot of that is around providing AI components that go into the chips of NVIDIA. So I'm really curious to see what IBM says in the short term about that, and that will underscore my thesis earlier that the AI trade and the cybersecurity trade is still on.
Keith, I'm curious what you make of the developments that we're getting out of China. Certainly a trending topic here at Yahoo Finance. China saying that's going to cut the reserve of requirement ratio for banks within 2 weeks, also hinting at maybe more support measures that could be to come down the line. Are you seeing investment opportunity there? And I guess what's your main takeaway from some of the instability or the fact that the recovery has taken much longer than what many forecasters had initially anticipated? What's the main message then to investors?
You know, my message to myself and investors is I think you can stay away from China for the next 9 to 12 months, and it's not going to hurt you. It's going to take some time for their policy changes to roll through the economy. And if you've ever traveled to China, you'll know what I mean by this statement. If you drive out on the frontiers of China, you'll see more high-rise construction booms than anywhere else in the world. They're still there, and they've built a lot of commercial real estate in that country, which they've got a problem with. The bill is coming due on those things, and they're not able to make that an earning or a useful asset. So that's one of the things that they're facing with right now. Why their stock market, their equity market, has started to take a hit, because people are looking at it overall and saying, is this a good investment structure when the Chinese government may have to come out and bail out billions upon billions of dollars in bad real estate loans? So again, I'm encouraged that they are taking some steps to do some things and right the ship. You'll probably see more over the summer, because it will be, they'll throw out a lot of money and they may gain an inch or a foot at a time, as opposed to several yards, you know, a breakaway run through the middle, so to speak. In China, let's face it, I mean, it is what it is. China has President Xi and his council, they wake up every morning and they got to figure out how to feed 1.4 billion people. And if the economy really tanks, that's an issue. And the last thing they want is social unrest, while there's still some political instability around the world, and while there's an election in the U.S. coming up. So they're trying to figure out which direction they're going to go in 25 and beyond.
Certainly a lot of things investors need to keep in mind, of course, and also just bringing up your last point there, just in terms of policy and exactly what that's going to look like if we do see a switch in the White House. All right, Keith, always great to have you. Thanks so much for coming in and stopping by the studio here with us today.
Yeah, my pleasure.
All right, we'll keep right here on Yahoo Finance. We got much more of your market coverage ahead. We're going to be taking a look at the Homebuilder space. Homebuilder indices here, bringing in some of the worst days that we've seen in months. Yesterday, the Homebuilder index having its worst day that we saw in just about 3 months. More on that and whether or not some of these stocks could be a buy when we come back.
U.S. home builders indices are not doing well right now. The Homebuilders ETF XHB hitting its lowest period in nearly 3 months, down over 3%. And the recent earnings report from D.R. Horton on Tuesday also signaling a potential weakening in the sector as mortgage rates hang around 6%. That's down from last year's high at 8%. Let's bring in John Lavallo, who is the U.S. Home Builders Building Products Equity Research Analyst, to discuss more. John, always a pleasure to get some of your insights here. You're out with an interesting call, reiterating your buy on D.R. Horton. Walk us into the thesis there, especially at a time where there is some weakening in terms of the sentiment from some of your industry peers.
Yeah, I mean, Brad, thank you for having me, first of all. Appreciate it. Look, everything that came out of D.R. Horton yesterday, aside from one factor, was decidedly positive, and it sort of echoed what we heard from Lennar and KBH over the past couple of weeks. So from a demand perspective, things are still very good. And in fact, I would argue getting incrementally better as rates have come down and as we're heading into the all-important spring selling season. The knock yesterday on D.R. Horton was a one-time hedging charge related to the fact that they're buying down mortgage rates for their clients. And what happened is, if you think about when the quarter started in October, rates were at 7.4%. They shot to 8%, and they came right back down very quickly to about 6.6%. That volatility created the necessity to mark some of these forward contracts to market. It's a very unusual thing that happened. It is not expected to repeat anywhere near the same magnitude. You strip that out, the company hit the midpoint of their margin guidance, and the stock would have reacted very differently. So from a demand perspective, things are still very good. One sort of idiosyncratic event that happened kind of derailed the stock yesterday. And keep in mind that these stocks are up 85% or were up 85% last year. And so pretty sensitive to anything that might look a little bit odd.
Yeah, John, that's very important to point out, given the fact that the movement that we saw, the reaction that we saw to the results yesterday. But we have to keep in mind the massive run-up that we've seen over the last 52 weeks. John, my question to you is about incentives, because that has certainly been a story that we have been following very closely. Home builders offering incentives to buyers here in order to boost some of that demand and some of their sales. Are we going to see the strategy there shift at all? Are we going to see maybe a pullback in incentives? And what do you think that looks like?
It's a great question, Sean. Yeah, I think there is the opportunity for the builders, given that rates are now lower, to at least lessen the degree of incentivization that they're using. And that would be very accretive to gross margin. Now, again, this is a very critical point in the home building year, if you will, as we head into the spring selling season, which typically happens, the Monday after the Super Bowl Sunday. And so at this point, builders are going to keep the incentives in place. Let's see how the spring selling season starts. But I think that there is going to be an opportunity to take their foot off the gas if rates kind of, stay in the range that we're in right now.
When we had previously had a conversation with Meredith Whitney on our air, who kind of laid out two major factors to this home buying market more broadly, or the housing sector more broadly, and it was needing to see a silver tsunami, a wave of boomers perhaps who were willing to relist their homes, and then additionally, into the buying side of that equation, a number of migrations that potentially could take place as well. What are some of the two big themes, perhaps, that you are going to be watching for here in order to say, okay, it's a green light back in this housing sector, despite rates being elevated from the levels that were extremely rosy for buyers and sellers?
Yeah, I think it's a great question. One, from the in-migration standpoint, yes, very important. If you think about where the public builders in particular they're building in the Golden Horseshoe or the Sunshine States, where the migration is coming because there's job growth and frankly, the weather's better. And so there's been a lot of movement into those areas. I also think that the baby boomers turning over more homes will be helpful. We have a very strong wave of demographics coming in from the millennials and Gen Z generation becoming first-time home buyers. I think, though, a couple things to keep in mind here. One, this group is set up to really kind of perform throughout a cycle. And I think this is what's being missed in the market with the stocks, is that these are viewed as stocks that have historically been poor stewards of capital, sort of land speculators that would put a home on the land ultimately just to monetize it. But now you're looking at companies that have solid balance sheets, that have outsized market share gains because there's no existing home inventory, the ability to generate solid cash flow throughout a cycle. There's a lot of things to like about these stocks, which I think over time is going to, allow them to command a higher multiple than they do today. I mean, they're trading at a 13-turn discount to the S&P, which in our opinion is just way too wide given the return profile.
Is there one particular name that you expect to outpace others, especially given some of the millennial cohort and group that you expect to continue to, over a multi-year process, flow into the housing market?
So we continue to like the builders that are putting homes into the market at affordable price points and doing it in a very efficient fashion. In many cases, that is what we call spec builders, where they're starting the construction of a home before there's a buyer in place. D.R. Horton is our top pick. It fits that bill extremely well. Other companies like Lennar, a very, very good builder, has a very strong first-time entry-level presence. And even Meritage Homes, ticker MTH, is perhaps a smaller version of D.R. Horton, but doing things very efficiently and providing, homes into a market where there's just no existing home inventory to compete.
All right, John Lovallo, great to get your insight. Thanks so much for joining us here this morning. UBS's U.S. Builders Building Products Equity Research Analyst. Thanks, John.
Thanks for having me.
All right, coming up, Tesla's new EV plans. Automaker telling suppliers about production plans for mid-2025 on a new vehicle. This is according to a Reuters report. More on that when we come back.
Tesla has plans to start production on a new mass market EV dubbed Redwood, according to an exclusive from Reuters. Let's bring in Yahoo Finance's Pras Subramanian to get some more of the details on this. Pras, what do we know?
Yeah, so this is a big scoop here by Reuters on the day of earnings, right? This reporting of this mass production of this cheaper $25,000 EV, possibly their Gen 2 car they had mentioned in the past, like a codenamed Project Redwood internally. Production, of course, potentially starting mid-2025, which is pretty aggressive. Kind of have to get that tooling in place for that a big rollout, and they want to do, I think, around, the sources told Reuters, around 10,000 units a week. So that's a pretty big mover, and it would start production potentially at Austin. Now, my understanding is that could this be a car that's also the robotaxi? Would it be a second car, two different cars? The sources told Reuters there could be two different or multiple cars with the platform. So we'll see where that goes. But I think the question is, can that timeline be reached? Right? Tesla's been known to basically overshoot their deadline. So Reuters sources told them 2026 is probably a more likely timeline for production to begin.
Yeah, because that would be a very, very close turnaround, right? We're talking about mid-2025. All right, Pras, let's talk about something that's going to be happening in just a few hours from now. You're going to be tracking the results that we're getting here from Tesla. Where does the street stand ahead of these results? And I guess, do you think we're going to see, in terms of what we hear from Tesla, maybe what we're getting here from Musk, just about the fact that do you expect, ease some of the concern that we have been talking about with lackluster EV demand?
Yeah, I mean, this is the big thing that people want to hear about. They want to hear about pricing versus product profitability, and then also what's going to be their new 2024 production target, right? So the street is looking for around 2.1 to 2.2 million vehicles a year for this year, which is only a 20% or so gain from last year, which is not that aggressive. But at the same token, can they actually improve profitability? There might be actually a sequential improvement in gross margin to 18.1%. That's the street kind of viewpoint on that, which would be a positive. But the question is, can we get more guidance on, are they going to cut more price-wise next year when they already did in China and Germany this year alone?
Yeah, certainly. Well, we will be closely watching for these results, and they break in just a few hours after the close. Pras, thanks so much. All right, we'll keep it right here on Yahoo Finance. Much more of your market action ahead. Again, you're looking at gains across the board. You've got the Dow up 85 points. We'll be right back.
Welcome back to Yahoo Finance Live. I'm Brad Smith alongside Shauna Smith. We're about 30 minutes into the trading day. Let's take a look at how things are shaping up. Stocks right now, they are trading higher as tech earnings spur the rally on, and the S&P 500 notching its third record high close of the year. We've seen that this week.
All right, well, let's take a look at some of those trending tickers. First up, Amazon shares up just about 0.4%, moving to the upside after Telsey raised its price target on the stock. They are expecting a very strong earnings season here in just a couple of weeks. Now, the analysts are boosting their price target to 185. That's up from 165. Why they like it? Well, they're expecting that stronger than expected holiday quarter, faster fulfillment, stabilization in AWS, also a greater focus on profits.
All right, that's the next album name for me. Greater focus on profit. Shares of Plug Power as well here, falling this morning as BMO expresses concerns that the company may have trouble securing funding from the Department of Energy. The analyst downgrading the stock to underperform, saying even with Plug's recent $1.6 billion DOE loan, they see a hard road ahead for further funding.
All right, and Chipotle announcing new benefits to help attract its growing Gen Z workforce. It's looking to hire 19,000 additional employees, ahead of this year's burrito season, which runs from March to May. Now, this is a step up from the 15,000 that Chipotle announced last spring. All right, well, Alaska Airlines CEO is saying that, quote, many of Boeing's aircrafts have been found to have loose bolts after inspecting the fleet. Now, pertains to the 737 MAX 9 here specifically. Now, this is all coming following the incident at the start of the month. Boeing announcing that it will pause production of that 737 model and what they're calling a quality stand down. So digging into this a little bit more, and if we could bring up the price of Boeing stock here and how that has been under pressure since this news broke. What stands out to me, Brad, despite all of the concern here, despite what we're hearing from some of these airline CEOs, is that when you take a look at analyst reaction, they haven't budged much in terms of their expectations. And Bloomberg put together some of this interesting stats here, saying that their average 12-month price target for this stock has dropped by just about 3%, right above a $265 a share, which is about $50, $55 higher than where we are trading today. So despite the fact that Boeing's reputation is taking a hit, it might be a bit tarnished, there's still reason to be optimistic, at least in the eyes of many of these analysts.
Yeah, the larger concern for some of the investors here who are tracking Boeing is whether or not this has an impact either on future orders for the MAX line. And notably, we've spoken with Delta about their order. That's set to begin in 2025. And then on the other side of that, whether or not you see a wavering in the commitment to execute on some of the options to take even more. And so that is usually part of it. You have the guaranteed figure that is announced, and then you have the figure that is an extra kind of add-on bonus, an option for additive deliveries and purchases there. So ultimately within this, I think that's where investors are right to look across a lot of the investigations that are taking place, both internally within some of the airline operators, but also in Boeing. Boeing itself this week announced that they're going to have a day of quality control. Essentially, they're going to be instituting some classes that are taking place within the company here. And so we'll see if that has a major delta on some of the maintenance, the operations, and even building out these aircrafts. But this is a company that just years ago was intertwined within its own culture of negligence that came to light as a result of the previous 737 MAX issues that resulted in, unfortunately, 2 fatal crashes that took place.
Yeah, certainly. It has been a tumultuous couple of years here for the company, to say the least. All right, let's take a look at one of the trending tickers here this morning, and that is AT&T, reporting results before the bell, missing on earnings, even as it added more customers than expected here. Now, this comes as Verizon came out with its earnings on Tuesday, which came in strong. So what's the play in the telecom space this year? We want to bring in Craig Moffett. He's MoffettNathanson's co-founder and senior analyst. All right, Craig, let's talk about this. Let's start with AT&T because we're looking at losses of shares just about 2%. There certainly were tidbits in this report that investors are taking issue with. But my question to you is, what do you think these results tell us just about the fundamentals of AT&T's business?
Well, look, overall, it was a quarter that was more or less what you expected. The results in subscribers, and you have to start, like any subscription business, with the subscriber counts, and the subscriber counts were pretty good. I think the challenge here is you look at this company and it's really not growing. It hasn't grown faster than the rate of inflation in a decade. You've had a lot of tailwinds during that period for wireless overall. And you look forward, they're not guiding to any material earnings growth. I think that's why the market is reacting negatively this morning, is the market had expected some material EPS growth. And you know, what you see is what you get with these companies. They're very slow growth companies. They pay a decent dividend, but the capital appreciation story hasn't worked in 30 years for the telcos.
You know, Craig, as the call had been taking place this morning, perhaps a lot of the focus may have not just been on the additions for subscribers, but also where the company is investing further here. Is there any of that investment, that CapEx that's going to be going out the door, that you believe AT&T has to get right in order to hit its next inflection point for investors?
Well, look, they have largely finished building out the 5G network, as have their peers. But the real question now is whether 5G will materialize as a real revenue driver. So far, it hasn't. It's been sort of a running in place type of investment, and an expensive one at that. On the wireline side of the business, what I scratch my head over is the convergence strategy, right? They spoke a lot on their conference call about the power of convergence and the ability to offer a wired broadband solution and a wireless broadband solution. That's a lot of what's driving the capital investment that they're making in fiber. Well, that's fine, but their fiber network will eventually cover something like 25% of the United States. What do you do in the other 75% of the country? They talk about it as though they're advantaged, but I think a better way to characterize it is they are perhaps less disadvantaged than their peers. But if convergence really happens, the cable operators are going to win the war, because cable operators can offer a converged solution everywhere, and the telephone companies that they compete with can't. And that's actually why I think, for me, particularly with expectations quite low for the cable operators are more interesting at this point than the phone companies are.
That's really interesting. And Craig, on the phone side, when we think about the net subscriber additions and what's actually going to drive even more people to the services, we think about our smartphones and how every company is telling us that artificial intelligence is just going to unlock our productivity within our devices that we're carrying around, some of us sleeping next to, for better or for worse. But at the end of the day, is that going to actually carry through to all of the telecom players here? And is there one that's better positioned versus others if we do see devices see a massive type of kind of critical mass adoption of artificial intelligence, co-pilots, solutions, and operations within these devices?
Well, if you see, I think I've been joined by my dog here on the sofa behind me. It's nice to know that she's paying attention.
She's into the convo.
I don't know that AI is going to drive a lot of incremental telecom revenue. As we've seen in past cycles, there are big winners in these kind of big tech cycles. The telephone companies are rarely on that list. They provide the infrastructure, but the spoils tend to go to someone else. In this case, I think you could possibly make an argument that AI will drive significant incremental traffic. If so, perhaps that's a positive, but historically that's not been something the operators have been able to monetize. As the network goes, it may also drive some demand for edge compute that is processing out at the edge of the network. But there again, it's not obvious that the carriers are really the ones that benefit from that. So I'm a little skeptical about the AI transition. In fact, what the AI transition is likely to do in telecom is drive a handset cycle, and handset cycles tend to be bad for telecom operators, not good, because by and large, equipment revenues are passed through at cost or at a loss. And so to the extent that you see AI driving incremental upgrades, that's probably not helpful to the carriers financially, at least.
Craig, in terms of the demand and the trends that we are seeing here over the last couple of quarters, do you think we're seeing more of a normalization, especially when you compare it to maybe some of the frothy levels that we saw during the pandemic?
Yeah, look, I think I struggle with the growth equation for the industry anyway. The growth rate of the industry by units has been 2.5 to 3 times the population growth rate in the United States. That's clearly not sustainable, right? I mean, we know that wireless penetration is essentially fully penetrated. So you've had some incremental growth driven by promotionality and pushing extra lines on people that they don't necessarily need or want. You've had some extra growth from just migration of prepaid to postpaid services. But I suspect that one of the challenges is, and there clearly was, as you said, during the pandemic, there was some pull forward of demand and younger people getting phones for the first time. To the extent that that's largely behind us, I think expectations for growth for the industry are probably too high. And that's important because if anybody's going to fall short of their expectations, it tends to lead to increases in competitive intensity to try to right the ship, because nobody wants to fall short and see their stock price be punished. And so you see these kind of knee-jerk reactions competitively to try to drive growth when the market just isn't there to support it.
Craig Moffett-Nathanson, co-founder and senior analyst. And of course, we got to give some credit to the lovely dog in the background as well here. Thanks so much for joining us today.
Thank you.
Thanks. All your markets action ahead. Stay tuned. You're watching Yahoo Finance. Netflix posting a big jump in subscribers for the fourth quarter, proving that it's still the big winner amid stiffer competition. So what is next? Consolidation's been a trending topic within the industry over the last several months after reports of talks between Paramount and Warner Brothers Discovery. When asked about M&A in their earnings call, Netflix's CFO made it clear about a space that they are not interested in.
We're not interested in some of the big linear assets that may or may not be available. We also noted that in the letter. And so I think that's how you should kind of think about our, what's out there to go after.
So for more on the future of streaming and the entire space, we've got Mark Debevoise, who is the Bright Cove CEO, joining us here in studio. Mark, great to see you. I mean, when you hear comments like that on the call, does it mean that Netflix perhaps is prioritizing its attention elsewhere in order to deploy capital, make strategic, maybe not acquisitions of linear, but elsewhere, whether that be content or some smaller player?
I think they realize that they can not effectively run the table, but run a tremendously successful and still growing business by really just acquiring content and content rights in the right bundles and the right packages. You saw the deal yesterday that they announced with the WWE. That's a really big, broad bet on how they can amplify their ad business, in my opinion. They're going after a much larger audience per event. in that regard, and that's going to help them drive sponsorships, drive bigger reach for their ad business, rather than so much frequency that they get from delivering, sort of series and scripted series. And you saw them peel back their investment in scripted series last year a bit. Interestingly, you saw their traffic go down a little bit, but subscribers go up, right? And you saw that strong finish to the year. I think that's tremendous for them. It gives them a lot of confidence that this strategy of going after content rather than full companies is probably the right answer for them.
So it sounds like you think we could see more similar deals to what was just announced in this week with WWE.
Yeah, I think, look, the other streamers have pulled back on content and marketing spend. They're having to rationalize their technology spend. That's effectively what Breakove does for many of these companies. We help them solve that technology cost problem. And Netflix doesn't have those issues, right? They've built that technology stack. It's in the right place. It's at the right cost level. They are profitable, so they can now swing for those pullbacks that the other companies are having in content and marketing. They can go after those subs. They can go after those shows, and they can find the right ways to invest and really drive subscribers.
How dependent is Netflix on advertisers continuing to spend and even ramp up the amount of campaigns that they're running?
Yeah, I think it's really interesting. You saw it subtly in their earnings call that they're going to raise price on the sort of more premium subs with no ads and keep that price low for the ad tier. When I was running Paramount Plus or CBS All Access, we had a significant lift from that ad, that ad-supported tier. You could get dollars and dollars per sub by delivering those ads. So when you see that $5, $9, $10 lower price point, you should be adding sort of 50, 60% of that in ad dollars, on a typical basis. So you start to see they may be agnostic as to where the subscriber goes because they're making just as much money on that ad tier as they are effectively on some of those lower end premium tiers.
Mark, I know you work with a lot of these streamers, but where does this leave the competition within this space? When you get a report like Netflix here, it's so dominant within the streaming industry. How then do you think executives of some of those smaller players are looking at this report, and do they have any ability really to compete?
So I absolutely believe some of the larger streamers can get to a very profitable and nice sized business at those 40, 50, 60 million subscriber ranks. So there's going to be numerous broad players out there over the long run. And the fact that they were running those businesses unprofitably for the last few years is probably a thing of the past, right? They're headed towards that profitability cliff. But then there's another 200 plus services that Nielsen tracks in their other category of streaming, and that's one of the fastest growing categories you see. So I think streaming is really just in a transformational phase. Netflix is the behemoth. They're gonna, effectively last forever for a very, very long time and be in the catbird position. But there's going to be dozens of other services, if not hundreds, of what I would call more niche and targeted services that are going after 1 million to 10 million subscribers and finding a great content strategy that can be profitable in that bucket. And that's just in the US. You go internationally and you realize that the cable bundle isn't deteriorating the same way. That channel bundle in Europe is holding together a little bit better. And so the broadcasters and the local and regional players have real strength. They get the big content rights. They're able to do it on both linear and streaming platforms, and they're able to execute in a different way. That's why you haven't seen effectively the FAST revolution, the free ad-supported streaming TV revolution that you see in Roku channel or Samsung TV Plus. It hasn't spread globally as well, right? It has been held back by the fact that the regional players are actually pretty strong in most of the other territories around the world.
If more of the sports licensing and the broadcasting goes towards deals with streamers, though, is that lighter fluid for the deterioration of some of the cable bundles?
I like what WWE did here. They really emulated the NFL, the successful strategy of having it on multiple places. You have SmackDown on cable with NBCU. You have NBCU doing big events on NBC. They own in Peacock the WWE, former WrestleMania rights and those pieces. You have Raw now on Netflix, going forward. That's a pretty broad strategy. I think Nick Khan and his team have realized having that exposure for your league is going to really, amplify the longevity of that league and the long-term audience. And so yes, you'll see deals with streamers, you'll see deals with broadcasters, you'll see deals with broad set of platforms from some of these leagues. And then look, as you get down in sort of smaller leagues, you may see more tight deals. Look at the NHL, one of our customers at Breakove, we manage streaming for them, but not the long-form streaming rights because those are captured by ESPN Plus, right? So you'll see individual deals with certain leagues that have unique capabilities.
Mark, always a pleasure to speak with you. Thanks so much for coming in studio here.
Yeah, great to be here, Brett. Thanks so much.
Thanks. Everyone, coming up on the other side of this short break, we've got more markets action for you. We're just about an hour into today's trading activity. 50 minutes for anybody who wants to fact check me, though. You're watching Yahoo Finance.
From iPhones and iPads to Macs, Apple Watches, and AirPods, Apple's products are a daily necessity for millions, and the numbers prove it. The company generated more than $394 billion in revenue in 2022 alone. But how were they able to achieve such staggering success? Beyond the Ticker charts its path to becoming a tech giant. Steve Jobs and Steve Wozniak founded Apple in Los Altos, California in 1976. That same year, Wozniak built the company's first product, the Apple I. Apple debuted the Macintosh with its now iconic 1984 commercial during Super Bowl XVIII. The Macintosh stood out because it was the first mass-market personal computer to feature a graphical user interface and mouse. Jobs left Apple after his famous falling out with CEO John Sculley in 1985 and subsequently founded the Next computer company. In 1991, Apple introduced the PowerBook line, which set the standard for most modern laptops. In 1996, after a run of CEOs, Jobs returned to Apple. The company purchased Next to use its operating system and named Jobs interim CEO in 1997. Apple introduced the iMac in '98, and the line would go on to sell millions of units. 3 years later, Apple debuted its first iPod, which could store roughly 1,000 songs. And that same year, the company opened its first Apple stores. But it was in 2007 that Apple unveiled its most important product of all, the iPhone. A revolutionary device, the iPhone helped create an entire business model around apps and the App Store. Jobs suffered from pancreatic cancer towards the end of his second term as CEO. He resigned from the company just before his death, and Tim Cook took over as CEO in 2011. In 2015, Apple took the wraps off of its first new device since Cook took over as head of Apple, the Apple Watch. Just 7 years later, Apple became the world's first publicly traded company to reach a market cap of $3 trillion. And in June 2023, the company unveiled its most ambitious product yet, the Vision Pro. A mixed reality headset, the Vision Pro is scheduled to launch in early 2024.
Welcome back to Yahoo Finance Live, everyone. Shares of Meta rising nearly 2% this morning. The stock is trading higher on a new the stock is trading higher as it's going to be reporting earnings very soon here. It struck $1 trillion in its market cap, though. We've got more on this just a little bit later on in the show. First time in around 3 years that it's hit that level, though.
All right, guys, let's take a look at Abbott because that's a trending ticker here this morning. Shares under a bit of pressure following its earnings report. You can see the stock off just about 3%. A lot of that is because of the guidance that we got out here from the company. Now, despite a solid report here in its most recent quarter, falling demand for its COVID-19 tests was also one of the issues here. So let's bring in Anjali Khemlani, who's closely following this. Anj, what do you think this report tells us just about what we could expect here in the year ahead?
Yeah, so it seems like unlike other companies that kind of relied heavily on their COVID profits, Abbott took a step to make sure that they have been actually beating the sort of slump that other companies have had, especially those vaccine companies. Abbott has also had the benefit of the GLP-1 boom. Despite earlier predictions that it could really hamper the medtech sector, Abbott has seen actually growth there as a result of these drugs, the Novo Nordisk and Eli Lilly drugs that have been coming out. They've seen an increase in the use of glucose monitoring systems. CEO Robert Ford said that they are actually seeing 7 out of 10 new prescriptions for their Libre device. So that's one area where the company is really seeing that strength and that growth. Meanwhile, there's also a pretty strong balance sheet as a result of this return to the use of medtech and med devices. They do have about $20 billion on hand to be able to allocate for mergers and acquisitions. That's something that analysts are looking for when it comes to the company's outlook. They haven't had any major deals in recent years, but executives said on the call today that they're not necessarily looking to utilize that unless it makes sense strategically, not just to sort of fill a gap. We've seen a lot of that happening with companies looking at how to really utilize, their market cap, their capital allocation to ensure more growth in the near future. So that's another area. And then on the COVID test, like you said, they've seen that soft demand. They're not really relying on it anymore, but they are looking at increases in general, or sort of a flat situation when it comes to the testing of what they have for tests. So that's sort of the story for Abbott. And, analysts are kind of concerned by that outlook on the guidance, kind of lighter than they expected, but Abbott seems to be, signaling steady 2024.
All right, Anjali Khemlani, thanks so much for tracking this. All the latest out of the healthcare space. Anj, appreciate it. Well, one of the hottest debates on Wall Street is when the Federal Reserve will start to cut interest rates. And 2 big economic data points out this week could play a crucial role in the timing of the Fed's policy decision. Let's bring in Preston Caldwell, who is the Morningstar chief U.S. economist, to weigh in here. Preston, great to speak with you. Of the data points that the Fed is going to evaluate most closely at its next meeting, where do you believe that it will give the most weight, especially in its inflation combating pathway that it's been on?
Well, I don't think anyone is expecting a cut to come in this upcoming meeting. It's really more about the March meeting. So we'll get a lot more data before March. However, with that said, I think with this week's data release, we'll have the PCE price index inflation released from that. And so the Fed will be watching that, just based off the CPI, we have a pretty good idea what the PCE price index is going to be, probably, somewhere in the range of 0.2 to 0.3% month over month, which is consistent with year over year PCE price inflation, as well as on a core basis continuing to trend down. And so, we think that as of December, PCE price inflation will dip to about 2.9% year over year from 3.2% year over year as of November. So it's still trending down as long as the monthly numbers continue to roll in positively. Obviously, the PCE price index is the one that the Fed focuses upon as their inflation gauge. And if that continues to trend the 2%, then that bodes very positively for a rate cut in March.
So certainly some optimism there in terms of the inflation picture and how exactly you anticipate that's going to play out. Preston, what are you expecting to see on the growth front, though? When we talk about the fact that the U.S. economy is slowing just a bit, how do you think that is going to be reflected there in those GDP prints that we've got coming up?
It's a factor, right? Because now that the Fed has neared its inflation target, it's going to start considering its other goal of assuring maximum employment, which is tantamount to having solid GDP growth. Now, our expectation is, if you look at the Atlanta Fed's GDP now, for example, it's calling for 2.4% real GDP growth in the fourth quarter, and that's the best predictor when we're this close to the data release itself. So GDP growth remains solid. That's a deceleration from where we were in the third quarter when things jumped up, but that's kind of the usual amount of noise. So as of now, it's not anything that would cause the Fed to panic and start cutting rates super aggressively. Now, with that said, there's a few other things to consider. We are expecting growth to slow in 2024. And even without that, I think the Fed would reduce interest rates anyways from currently restrictive levels just based on inflation coming back to normal. But yes, if growth slows further, then that adds further fuel to the fire for rate cuts, obviously.
Is a soft landing firmly in play here for the Fed?
That is my base case. I think what we've learned now that we didn't know a year ago is that a soft landing is definitely possible. So it's within the range of possible outcomes insofar as we brought inflation down over 300 basis points over the last year, even as real GDP growth has accelerated. Whereas a year ago, people were worrying about the stagflation scenario where inflation remains high even as growth is weak. If you have that happen, you have to have a recession to bring inflation back to normal like we saw in the early 1980s. But we know now that a soft landing is possible, but that doesn't mean that it will be achieved, because if the Fed keeps rates too high for too long, we could still have a recession. And on the flip side, if maybe it cuts rates, the Fed cuts rates too quickly and the economy remains very strong, then that last mile of inflation could be hard to extricate. The economy could continue to overheat. But right now, I think a soft landing is the most likely outcome.
All right, you're not alone with that prediction here, but we will see how this all plays out. All right, Preston Caldwell, Morningstar's the chief U.S. economist. Thanks.
Thank you.
Keep it right here on Yahoo Finance. Much more of your market action ahead. We'll be right back. All right, former President Trump's New Hampshire win further solidifying his dominance as the leading GOP candidate for the 2024 presidential election. Now gets us closer to that potential Biden and Trump rematch, what we saw play out in 2020. And if Trump wins in the general election, we likely, obviously, will expect big changes in policy. One of that is the U.S.'s stance towards China. Let's talk about this and what it could potentially mean here for investors. For that, we want to bring in Lee Munson, who's very closely following the impact on the markets. He's Portfolio Wealth Advisors President and Chief Investment Officer. Lee, it's great to see you. I'm just going to toss it to you on this overarching theme and specifically what we're talking about with China. Is Trump or is Biden better for a company like NVIDIA, given the stance that we've seen from both in the past?
I don't think either is good. You've got 25%. NVIDIA's a little cagey about, the stats of data centers sales to China. So I think that one thing to remember is both Trump and Biden have had harsh stances on China. Here's what the problem is. Biden is obviously a little bit more diplomatic. Biden obviously rolls a little slower, and that's not a joke on his competency. But when you look at Trump, he's mercurial. Trump could just cut off the tap. Trump could just say to NVIDIA, you can't sell anything. Whereas with the Biden administration has basically said, you've got these things called the H100, the A100, these are little chips that NVIDIA sells. And last year, we started seeing that they had to unveil lesser, weaker versions of that. And so far, the Biden administration, US government is fine having NVIDIA sell sort of watered down chips. And if they want to do anything else, they have to sort of say, mother may I. I think with Trump, that's not going to work. I think Trump could very quickly turn against China, and then all of a sudden you have an embargo, and that would be very bad for stocks like NVIDIA.
What is the impact to U.S. companies who still have some reliance, or in some cases, an outsized reliance in their revenue base on China if we were to see a kind of pullback or perhaps patriation more so of just the international relations policy that we have if Trump were to get back into office?
I think it's going to accelerate what Trump started when he was president first. I think it's going to accelerate what Biden continues to do. I think the message here is that Biden has not been friendly to China, but Trump's going to be even worse. And so that acceleration is going to happen. I think we have to remember, China's been a problem for about 2.5 years. Started in August of 2021, when the president, their leader for life now, started talking about common prosperity, which is not what any red-blooded American capitalist wants to hear. And I think that we've already begun over the last 7 years a de-globalization and where we have a multipolar world. Now, not to get too wonky on the topic, but I think no matter who wins, Trump's just going to accelerate it going forward for the next 4 years. Relationships are not going to get better with China. And I think companies that rely on China for sales, companies that rely on China for supply chains, they're going to continue to have to adapt and reshore, different shore, and find any shore but China going forward. Now, the problem with that, it's the second largest economy. Nobody really wants to do that. We still do billions in trade. But if we get a wingnut in the president, in the White House, and we get some guy that wants to shoot from the hip and shoot off his mouth, the variability of outcomes for those companies that rely on China for whatever, it's going to cause more volatility. And volatility means the stock price not always going up.
And so where is that kind of biggest company exposure that you see from your purview?
Well, it absolutely is going to be in the chip sector, right? We have so much that's made in Taiwan right now, and I think that that's what I'm really concerned about. But let me give you some hope. Out in Mesa, Arizona, about an hour by plane from where I'm here in Albuquerque, we've got, a half a dozen fab plants from Taiwan Semiconductors, Intel, and there's going to be more in the making. And in a few years, these things are going to be online, and we're going to be reshoring chip production. So this is a little bit of race against time. How long before we can start really making the bulk of our domestic chips and the higher end stuff that Taiwan Semiconductor makes, especially in AI, how many years before we start making those out in Arizona and in the continental US? And I think that's a real question that you want to hear from management. That's a question that you want to follow if you're concerned about how these international relations are going to affect the price of the stock. But if we get a sort of a hot war or some sort of problem with Taiwan, I think all bets are off, and I think you're going to see real changes to valuations. Longer term, I think we're fine. But the next 2 or 3 years, this is a huge transition period where we're trying to make more here, and I think that that's what it comes down to.
Lee, let's talk about production here in the U.S. and talk a little bit about oil, because we know the politics of oil. It's a bit tricky for Democrats, especially because we know President Biden administration pushing these green energy policies. Yet when you take a look at the numbers, U.S. oil production hitting a record under Biden. So if we do see a change in the White House, what does that then mean for the energy trade?
Well, I think the energy thing with Trump, obviously, people are going to run up the stocks. I mean, that's an obvious trade. They're going to look at more deregulation. I mean, but let's be honest. Just what you said. More oil extracted under Biden than any other, time in U.S. history, right? And that's because Biden's not really as tough as he says. But that's not the perception from investors and traders. If Trump gets into the power again, people are going to just presume it's going to be free for all for coal. It's going to be a free for all for fracking and free for all fossil fuels. My problem with the Trump presidency concept, or that obvious trade of go long energy, is what's going to happen to the green energy companies. When we're thinking about it, Nikki Haley, which doesn't look like that's going to happen, at least she was diplomatic. At least she would admit that climate change was caused by people. At least you can say that there could be two worlds. But I think with the Trump world, the trade is to go along traditional fossil fuels and thermal energy, as we might call it in Wall Street. And I think it's going to be very hard for some of these ETFs that just invest in green energy. And the only thing that's going to save those companies are low interest rates and a lot of cheap money, because they lose money. And I think that that's really what we have here. Whereas Biden, I don't think Biden's going to crack down as much as he wants to say. I wouldn't sell all my energy positions if Biden becomes president again. That's ridiculous.
Lee, thanks so much for the perspective, the context here. We'll see exactly what voters prioritize and where some of those different prioritizations move around leading up to November here. Boy, a long time till then. Lee, thanks so much.
Thank you.
Coming up, which companies are best positioned in the AI space? We cover this and more as part of Yahoo Finance's AI Revolution Week. That's next.
AI is going to be bigger than the internet, so everyone says. If so, everyone is going to want to make a buck from it. The tectonic shift is happening, but is there a revenue wave that goes along with it? And who's going to catch it? The likes of NVIDIA, OpenAI, and AMD have reaped the lion's share of the rewards so far, but fervor will surely line more pockets in the coming year. Will Microsoft's AI Copilot add $10 billion to annual revenue? How big a selling point will Salesforce's Einstein become? And which disruptive startup is getting this year's big check from venture capital? We answer all these questions and more.
Tech stocks are back on top, driving the current market rally amid renewed momentum in the AI hype.
And while the rising tide seems to be lifting all tech boats, at least for now, when it comes down to the bottom line, which industries really stand to make a buck here from AI? Dan Halley has been tracking this for us. Dan, where do things stand?
Yeah, Shauna, there's a few industries that are seemingly getting a good amount of AI play. And I just want to go over them real quickly, and then we'll get into the businesses that are really making some moolah on this. So just some of the industries that you can think of are automotive. They've been doing this for a little bit now. If you think of self-driving cars, it's AI, right? We talk about generative AI, the big explosion from ChatGPT, but AI has been around for quite a while. It's been on my phone. It's going in a lot of smart TVs, and it's part of the automobile now, whether it's keeping you in your lane with lane assist or warning you about people in front of you with that kind of automatic cruise control. Another one is actually agriculture, which is really interesting. At CES, the Consumer Electronics Show, there were tractors that can look at a field and then notice where a weed is and then spray only on that weed. It makes sure that herbicides aren't being sprayed over everything, and it helps save them some money. And then obviously healthcare, that's something where generative AI is looking to break in, where it will allow doctors to quickly summarize what they see from patients, giving them a quick rundown. Those are some of the industries. Let's look at some of the companies, though, that are starting to make some of that cash. We'll start off with the big one. Obviously, we have Microsoft and Google. They are making money through OpenAI with Microsoft, that team up, and then with Google, their Gemini. Right now, what Microsoft is doing is they're offering their Copilot 365 for $30 per seat per month. That's per person. Those are for every business now. They recently opened that up for every business that wants access to it. Previously, it was just larger businesses with 300 employees and more. Now, they're selling it for $20 a month for regular folks. We also have Tesla in there. They're using AI. Meta is using AI. They've been using it for a while, but they're really leaning into it. You saw that they're spending billions of dollars on NVIDIA chips. Speaking of NVIDIA, they're also making money hand over fist. We'll see how they do in their upcoming earnings, but they are just crushing it as far as bringing in the cash. And then AMD, one of their others, doing a big amount of money as well. Amazon, also one of the companies that's making cash. They've been offering different instances for Gen AI and AI that companies can then latch into and build their own AI capabilities through. So they're doing that. On the chip side, we obviously have NVIDIA, Intel, TSMC, absolutely dominating because they make the chips. They're the ones that make it for the likes of Qualcomm, for Meta, for Microsoft, for Google. They're the ones that are doing all of this. So they're the powerhouse behind that. Intel trying to make its way in. But look, they're not on the AI side as much as something like an NVIDIA or an AMD. However, when you look at AMD or NVIDIA, what they sell, NVIDIA, they sell graphics cards. They're trying to get CPUs. Intel makes the CPUs that work with those. So anytime you see a new graphics chip going into from NVIDIA into a business's servers, Intel is connected to that to some degree most of the time. So don't sleep on them when it comes to this huge amount of money that's coming from AI.
All right, Dan, thanks so much for breaking that down. We want to talk a little bit more about the impact that AI is having on a number of companies. For that, let's take a look at some of the headlines that we're getting out today. And SAP is the latest tech company to announce a workforce change. The German software giant is restructuring 8,000 jobs as it prioritizes artificial intelligence.
Restructuring and layoffs in the tech sector has sparked fears that investment in AI could start to push out human workers. So how much of this concern is warranted is the big question. We've got Meredith Whitaker, who is the AI Now Institute co-founder and chief advisor and president of Signal Foundation. Meredith, great to have you here with us. You know, as we think about where we're really going to see a delta as a result of AI replacing human workforce, what is the early expectation now? Where is that even perhaps starting to show up in real numbers?
Well, great to be here. And I think we need to back up a little bit and recognize that AI isn't going to autonomously replace people's jobs as a product of scientific innovation. That we've seen layoffs in tech before. We've actually seen wage fixing collusion in tech before, which they got caught for. And there has been a desire to reduce workforces that predates this current moment of AI hype. So we need a grain of skepticism here. And I think we need to look at the role that AI plays in providing a pretext for cutting jobs. I would look to the Writers Guild of America and the struggle that played out there over the potential of the Hollywood studios introducing AI technologies in ways that the writers, I believe, rightly feared would undermine their livelihoods, would enable paying them less for work that was nonetheless skilled and nonetheless necessary, but was now categorized as less valuable than it was before the introduction of AI. So I want to be careful with any framing that would presuppose AI is actually capable of replacing jobs, and be a bit skeptical of these claims, particularly when they're made from the very same companies that are looking to profit from licensing and providing AI services to employers.
Hey, Meredith, it's always important to put it in historical context and exactly what we have seen prior technology advances, how that has impacted the workforce and beyond. Of course, but Meredith, when we take into account what has happened, and maybe this is also looking back and comparing this historically speaking as well, the adoption of AI, how would you compare that to some of the technological advances that we have seen of the past? And when we talk about the rate of change that maybe we could see in the workforce, whether or not the debate out there about what we were just talking about, whether or not it's going to replace jobs, if it's simply going to be more of a restructuring and reskilling of the workforce, eventually creating jobs, what does the timeline look like for that when you have just it seems like by the day, more and more companies talking about their investments in AI and how that's going to shape their company's future?
Well, I'm not a clairvoyant, and it's not clear to me what the timeline is. And I say that as somebody who has been witness to many bold prognostications that never came true. 10 years ago, we have AI scientists talking about replacing radiologists. That hasn't happened. We have predictions about autonomous vehicles surpassing human-driven cars that have not happened. And in fact, those predictions have been rolled back. We now have one autonomous vehicle company still operating, that's Waymo, as their competitor Cruise has been forced off the road due to issues with their functionality, issues with the way that their automated system worked and caused traffic problems. So I, again, want to be really hesitant with making predictions, particularly when we recognize that a lot of these stats are coming from the same industry that is hoping to find a market fit for this technology that they've invested billions and billions of dollars in developing, producing, and marketing.
How can people in the labor force successfully kind of retool, reskill their own set for a future of perhaps working alongside artificial intelligence?
Well, let's be clear. I don't think in many cases that workers are the ones who have the power to reshape themselves so that they can work alongside AI. I think what we need is to see increased union density so workers have more leverage over deciding where AI is introduced and how it's used and how their job is structured or restructured. And I think we need to recognize that in many cases, particularly in the US, which is a very non-union dense labor market, we have a case where workers are not the ones using these systems. Workers are the subjects of these systems. The employer licenses the system. They determine how it's used. They determine how workers interact with it or not. And oftentimes these systems work quietly in the background. We can think about new versions of Microsoft Office that are shipped to enterprises that include the option of creating a productivity score about workers that is then sent to management. This is generated through some version of AI, informs management, but cannot be considered something that workers necessarily have knowledge or power over.
All right, Meredith, we got to leave things there on the day. Meredith Whitaker, who's the AI Now Institute co-founder and chief advisor and president of Signal Foundation. Thanks for taking the time here today.
Great to be here. Thank you.
Another ticker that we're tracking here today. Shares of Meta rising around 2% this morning. Stock trading around $393 a share. Why is that significant? Well, the tech giant's market cap getting above $1 trillion for the first time in around 3 years, 2021 last time that we saw that. You think of what the company has had to go through. We had a year of efficiency in 2023. We had even more focus on what type of products it would actually, hardware products, it would put into the market. And then on the services side, or the Instagram, Facebook, and then, of course, WhatsApp and Messenger side, what needed to be iterated upon in order to drive even more time spent, retain advertisers, and see some of the overall spends move higher as that time spent for the end users continued to go up. And so that is one of the considerations here. And the company reports earnings very soon here within this earnings season.
Yeah, just about next week. So we'll be hearing a little bit more about that from Meta in terms of their plans for the future, how exactly they're allocating some of those cost-cutting measures that we did see take place in their year of efficiency. But it clearly has worked for the stock price, right? When you take into account the massive run-up that we have seen. All right, that does it for us today. Rochelle Akufo, Kiko, have you for the next hour.
Welcome to Yahoo Finance. It is 11 a.m. on the East Coast, 8 a.m. on the West. I'm Akiko Fujita alongside Rochelle Akufo. Here's what we're watching at this hour. More trouble for Boeing after Alaskan Airlines CEO says the company found loose bolts on several 737 MAX 9 planes in its fleet. Boeing CEO set to meet with lawmakers today.
That's right. And the self-care investment play will speak with one strategist giving her top picks in the beauty sector.
Plus, which tax mistakes could be costing you thousands and how you can avoid it. We're going to speak with an expert later on in the hour.
That's right. But first, let's take a look at how the markets are faring an hour and a half into the trading day. Looking at green across the board, although it has been something of a volatile morning. As you look at the Dow here, currently up over 100 points on the day, about 1/3%. The S&P 500 also in the green there, up about 32 points on the day. And the tech-heavy Nasdaq also up just over 1%. Could we be in for another record-setting day? We shall see. Let's also check in, though, on how the Treasury market is faring as we are in the thick of earnings season, still getting some economic data out this week. Looking at the 5-year retreating down 1/3%. The 10-year also down about 1/4%, though still solidly above that 4 mark. And then looking at the longest 30-year yield, that's also down, but ever so slightly, down about 0.2%.
Well, Rochelle, we are kicking things off with some key headlines we're watching today. Chinese authorities looking to inject additional stimulus into the world's second largest economy. The PBOC, China's central bank, announcing a cut to the reserve requirement ratio, reducing the amount of cash banks are required to hold in reserve. This in a week where we saw China's benchmark CSI 300 index hit a 5-year low. And Rochelle, we've been talking about this for some time about what additional stimulus measures are likely to come out of China at a time when we have seen a significant slowdown in the economy. The size of this triple R cut, certainly something to note, 50 basis points as opposed to the 25 basis points we've been seeing over the last few years. And of course, we've been watching this in the context of the markets as well, a real lack of confidence, if you will, in Chinese investors in their home market. We talked about the CSI 300 hitting a 5-year low. These Bloomberg reports coming out this week as well that Chinese authorities are looking to shore up roughly $280 billion in offshore money as a part of a stabilization fund, essentially creating a floor in a time where we have seen roughly $6 trillion wiped out from Chinese equities since the peak we saw in 2021.
It's true. I think this was clearly a confidence boost that was needed, but you have to wonder if it's enough. Usually you sort of see China make these very, very big moves, especially as we were expecting a real rebalancing after they came out of their zero COVID policy that didn't materialize. And then when you think of a lot of the companies that have the biggest exposure to China's market, of course, you're thinking your Apples and your Tesla. We keep hearing that those markets kind of being some of these make or break issues when it comes to some of the consumer demand that they're seeing as well. It is interesting to note, though, the Chinese stock market, somewhat different when you think of the US stock market, because it is a lot of retail investors. And one of the things that drives retail investors is how they're feeling about their personal economy. And as we've seen with the property sector, that's also been playing into some of that uncertainty to really want to continue to play in the Chinese market, Akiko.
Yeah, it's been part stimulus, part messaging, right, from Chinese authorities saying, trying to inject confidence back into the market. To that point, we did see Alibaba co-founders Joe Tsai and Jack Ma buy up roughly $200 million in Alibaba shares this week. You could argue, on the one hand, that's a move to inject confidence. On the other hand, it is a sign of confidence. If the co-founders are willing to buy up these shares in this amount, maybe the outlook isn't as bad as it seems. I mean, certainly going to be a lot of questions there, but interesting developments coming out of China as we continue to track that economy.
Indeed. And speaking, of course, of developments, also looking at Boeing CEO Dave Calhoun in the hot seat on Capitol Hill today in the wake of the Alaska Airlines midday blowout of its 737 MAX 9 door plug and, of course, the subsequent fallout and some of the other issues that we've seen. Now, of course, this is happening in a week full of airlines earnings and, of course, frustration over the response from Boeing so far. Now, something that's really adding some salt in the wound here is someone who cited that they were familiar with the work, speaking to the Seattle Times, saying that the fuselage panel that was removed and then repaired improperly by Boeing mechanics in the rental final assembly line. Now, this would be an issue considering the blame here, because the original installer was Spirit Aerosystems, not to be confused with Spirit Airlines. But this is something that hasn't been confirmed by Boeing. We've reached out for comment, as well as by the NTSB. But it does really speak to this issue of of the oversight of this and really some of the ongoing problems that it's been having. Now, it is going to be having the first of what it's called a quality stand downs for the 737 model. Now, that's going to take place in Renton, Washington tomorrow, according to their commercial airplanes CEO Stan Deal. And worth noting, United has more MAX 9s than any other airline. So we're seeing that frustration come out too.
Well, I mean, quality control, the big question for Boeing in that standout you mentioned. I mean, you have to wonder, is that enough to reinstill confidence that Boeing has a handle on this situation? You mentioned United. We're getting a better sense of the fallout from this particular issue with the MAX 9s. United yesterday saying they expect to post a first quarter loss as a result. Also, CEO Scott Kirby there talking about a delay that he's expecting now with the MAX 10s. Now, if you'll recall, when that initial order was put in for 277 jets there, that was expected to be delivered in 2020. So it's not just about the delays, it's about the quality, these issues that continue to pop up. And the biggest customers for Boeing saying, look, we have serious questions about whether, in fact, they can deliver and whether these planes are going to be safe.
It's true, and obviously we'll see what we'll actually hear from them when they face lawmakers today. But obviously that frustration trickling in and hitting some of those earnings reports there.
Yeah, Alaska Airlines also reporting on Thursday, so we'll be watching that one closely. Well, the biggest names in tech joining forces with the National Science Foundation to create an AI research program. Dubbed the National Artificial Intelligence Research Pilot Program, it's designed to create a resource for researchers, educators, and students to access AI tech. Yahoo Finance's very own Dan Halley to break this down for us. Dan, in simplest terms, what does this mean?
Yeah, Kiko, it's a weird name, research resource. They're calling it NAIR, and it's the National Science Foundation. Basically, the idea here is to provide communities, colleges in rural areas, minority institutions, community colleges, as well as other researchers, access to the kind of hard to get resources that they need to run AI experiments or conduct validity checks of certain types of AI. And so this is basically going to allow for that. Companies ranging from NVIDIA, Amazon, Microsoft, OpenAI, Anthropic, IBM, Intel, Meta, they're all on board here with providing some means of resources for this program, whether that's compute, which is basically the ability to run some AI programs on a company's platform, or some type of instruction on how to perform types of AI research using a specific type of chip, things along those lines. They're offering that for this program. Government agencies are also involved in this, ranging from the Department of Energy to NASA, as well as the Institute of Health, basically looking and saying, how can we get AI to work for us, and how can we ensure that the U.S. continues to maintain a leadership position in AI? And some of the places that they want to initially start trying to use these capabilities is in healthcare, as well as other forms of research related to climate change. And so this is going to be something that will run for 2 years. It is a pilot program. It's part of Biden's AI executive order that he had signed a few weeks back. And so this is kind of proof in the pudding that the U.S. is trying to ensure that it keeps that lead in AI. And it's working with the private sector as well with their vast resources.
So Dan, what does this mean for institutions like community or minority colleges and of course rural areas as well?
Yeah, I mean, look, you talk about how hard it is for companies to get a hold of chips from, NVIDIA or AMD or Intel or anyone else. They're expensive, and the capabilities to run AI experimentation is expensive. And so this means that those areas will also be able to gain access. One of the examples that the National Science Foundation had said was, look, if there's a community college and they want to explain to their students how to use AI to model different types of climate change, they can do that now. This is what this project is for. And so it really will be a kind of game changer for those types of colleges and communities. And so, not every college has the kind of bankroll that some of the big dogs do. And so this means that they will also be able to play in the AI space. And you never know where these different developments are going to come from. So it's important to provide these kinds of resources.
Indeed. We'll continue to keep an eye on that. And I believe this is a program that's going to last for about 2 years, so we'll see what progress is made during that time. Our very own Dan Howley. Appreciate that update. All right, well, let's look at some trending tickers. We have our eyes on electric vehicles, starting with Tesla. The EV maker is telling suppliers to start mass market production of a new crossover car. That's according to a report from Reuters. And this comes ahead of the car maker releasing its Q4 earnings today after the bell. Now, this is interesting, the fact that they're announcing this, but we know there's going to be a lot of focus, of course, on margins and, of course, delivery estimates as well for Tesla, as well as really some questions about leadership going forward, especially in light of Elon Musk asking for that 25% voting control here. But interesting after all this time to finally see what's supposed to be a mid-priced crossover SUV vehicle. It's supposed to be around $25,000. So really competing with some of that pressure that we've seen them taking from BYD.
Yeah, I mean, that's the key, right? $25,000 price tag, well below what the cheapest car that Tesla has on the market right now, which is the Model 3, roughly at $38,000 at a time when Tesla was overtaken by BYD as the largest EV maker. Now, the pricing issue is certainly going to come up in the earnings call, no question, because Tesla has had to undergo multiple price cuts to remain competitive in this market. But Rochelle, this isn't just about a Tesla story. You could argue that what we have learned in the slowdown that we have seen in EV sales is that this next round of buyers, if you want to talk about the first adopters already underway, this next round, they're looking for a cheaper option. And there is a concern, yes, about infrastructure, but there is a concern about price tag. Right now, Tesla's cars don't necessarily apply for federal subsidies. And so you take that out, you've got a $38,000 car at a time when there are cheaper options like a Kia out there. They've got to just sort of face the reality of where things are. You could argue also the other thing, Rochelle, you've been sort of teasing out, right, is that this may be an anticipation of this expectation that BYD is going to increasingly compete on a bigger level outside of its home market. Questions about whether they're going to enter the U.S. market, but Tesla's got to have a cheaper option if they're going to go head-to-head with BYD.
Indeed, and I think especially when you think of also the resale value of Teslas and other EVs, that's also sort of another thing that people worry about. And then, of course, Hertz releasing that fleet of some of their rental cars up for sale as well. Also sort of messing with some of the pricing as well, trying to really get a gauge on what people consider the right price point for the second round of adopters, as you mentioned, Akiko.
Yes, another question to come up in the Tesla earnings call, I'm sure. Well, staying in the battery-powered lane, a Baird analyst is initiating coverage of Nikola, the firm rating the EV maker is outperformed with a $2 price target. The analyst saying there's opportunity to capitalize on the zero emissions trucking space. But take a look at that share price, Rochelle. We're talking about this company trading below that $1 level, now facing delisting from the NASDAQ yet again because they have been trading below that $1 a share level for more than 30 consecutive days. So, sure, you can make the argument about Nikola having sort of this stronger runway here as Baird has, but you have to wonder about the viability of a company that's trading at 70 cents a share.
I mean, it's true. It's one of these stocks that you keep waiting for it to take off and have its moment. I believe they thought they did with some of their, proprietary design, especially when it came to their trucks, but it doesn't seem to be taking off. It's interesting, obviously, Nikola Tesla, the full name of the inventor from way back, but to have these two very different futures that they've both been a part of here, interesting to see. But a cheap stock, still keeping an eye on what we're seeing in terms of cash burn and liquidity, though, as well, something to watch as we continue to track both of these EV stories. All right, coming up, the self-care investment play. We'll speak with MarketGauge.com's Michelle Schneider next. We're nearly 1 month into 2024, and for many people, a new year means new goals for the year ahead. Our next guest is calling 2024 the year of the vanity trade. Here with more is Michelle Schneider, Chief Strategist at MarketGauge.com. Mish, good to see you. So we're talking about vanity stocks, which covers investments in beauty, skincare, self-help, diet, drugs, and dating. Why do you think this is going to be the year, and what are some of the standouts for you?
Well, good to see you both. Well, let's start with the fact that last year the market really depended on the consumer. And where did the consumer go? Did a lot of traveling, a lot of eating out, and emerged from the doldrums with a sort of YOLO attitude, right? You only live once. And as I started to see those trends change, I started to realize that I was talking to more and more people, and not just women, but men and women, who were talking about, you know what, this year, I want to take care of myself more. I've neglected myself. I've gained weight. So Ozempic, obviously has hit the market. And then what does that trickle into? I want to take care of my skin. I want to wear nicer clothes. I want to work out. And when I started to put that together, I started to look at all the stocks that really are relevant to that, from a fashion chain like a Ralph Lauren or a TJ Maxx or a Columbia or an AEO to makeup, which would be Coty and e.l.f. or even Nu Skin. Then I started looking at things like dating. Maybe people would start dating, so Match and Bumble. Working out, I was particularly interested in Peloton. And then in terms of from the biomed space, companies like AbbVie and also companies that are making more injectables, like Novo, for example. So I put that all together. I almost came up with a basket, if you will, of an ETF we could call Vein. And it's an interesting basket because some of them are doing really well, and some of them are, still floundering near the lows and could emerge as the year goes on.
Yeah, I like that ETF vein. I feel like that would catch on pretty quickly. Michelle, this comes at a time, though, when we've been hearing more and more on these earnings calls, too, that discretionary spending is pulling back. Consumers are sort of becoming a little more cautious. So if the spending is happening in the vanity space, where's the trade-off? What are they doing instead? Like vanity instead of what?
I would say vanity instead of the discretionary spending that we've seen in a lot of recreational activities outside of the home, whether that would be travel and in eating out, that kind of thing. I mean, we still have obviously a strong service economy. The numbers even that came out today showed the service industry is still strong. But I would imagine that if we're going to cut back, and I could just look at it from a personal standpoint, if and I'm not saying I'm doing this, but if I were saying this is the year I'm going to just focus on me, where would I cut back? Most likely I would cut back on going out to eat because the food prices are still very high. And very quietly so far this year, Akiko, we're seeing sugar go up. We're seeing DBA, which is, talk about ETFs, that basket of a lot of agriculturists, all of a sudden gapped up and keeps flying higher here. So, if you're gonna say, well, I still need to feel good about myself and I can feed my family, but I can still take care of myself because after all, at some point, people have to feel good about themselves in order to even take care of their families. That's where we're looking. But you brought up a great point, and that is the consumer in general. And that's why in this little thorn in the side of vanity, if you will, is ETF XRT, which is talk about a nice basket of staples and discretionary stocks in the retail space. That is really falling behind. And even as we're speaking today with SPY and Qs making new highs and lots of the growth stocks, that is just sort of floundering and actually has been read a couple of times already this morning. That could be an indication that we're not quite ready to maintain the highest prices of the beauty stocks we talked about, and the ones that have been beaten up could go lower. So, it's always going to be timing, but keep an eye on XRT.
And Mish, I want to take a deeper dive into some of these beauty stocks, especially when you look at the performance of e.l.f. over the past year, up 183%, whereas you look at Estee Lauder down 53%. What are they doing right? What is it about either the product mix or the fundamentals of the business that are making them more of a standout?
Well, first of all, they're they're more broadly represented, like, Ulta, for example, would be a big carrier of it. I think also, believe it or not, it's a sexy name. And so you've gotten into a lot of people, oh, I love e.l.f. products. And whether they really love e.l.f. products compared to Estee Lauder products or Coty products, what is that really based on? So I think there's just been this overall mentality, and they're priced well. Their products are priced well. But you can see just from that whole movement up, whether you're going to compare it to Estee Lauder or Coty, and Coty's not doing too badly, it just hasn't really broken out yet. Yeah, that's like the NVIDIA of semiconductors, if you will. It's been more popular, and therefore more investments, and therefore more profits.
We didn't even get into GLP-1 there. Michelle, much more to come. We'll have to have you back on the show. Michelle Schneider, MarketGauge.com strategist. Good to talk to you today. Appreciate the time.
Thank you so much.
Well, coming up, Netflix doubling down on its sports strategy. How this squares up against the competition, we're going to discuss on the other side. We'll be right back. Well, Netflix out with more details about its future sports strategy after announcing a new partnership with the WWE. But should investors expect more sports deals from the streaming giant moving forward? Yahoo Finance's Ali Canal joining us with the details. Ali, a lot of questions on this one in the earnings call yesterday, but we've heard over and over from Netflix that it's not specifically about live sports. There is a certain framing. I mean, what more do we know now that this other sports deal has been signed?
Yeah, you're right. Basically, this shouldn't lead us to expect Netflix is going to commit to any more sports deals related to those professional leagues. Like you mentioned, his co-CEO Ted Sarandos was specifically asked about this on the earnings call, whether or not the WWE deal could open the door for other deals with leagues like the NHL, NBA. Here's a bit more of what he had to say when asked about that.
WWE is sports entertainment. So it's really as close to our core as you can get of that sports storytelling. And in terms of the deal itself, it has options and it has the protections that we seek in our general licensing deals and with economics that we're super happy with globally. So I would not look at this as a signal of any other change or any change to our sports strategy.
So sports entertainment, this storytelling of sports. And there's been a lot of debate out there whether the WWE, if you could consider that sports or if it is solely entertainment. But Netflix has been really consistent with that messaging. And simply because they don't want to pay those high sports right fees. And for good reason, because those annual fees are very expensive. You have the Amazon NFL deal that's valued at over $100 billion over 11 years. Comcast Peacock shelled out $110 million for the rights to broadcast just one NFL game. You have that Apple MLS deal, soccer, certainly more of a niche sport here in the US, but still $2.5 billion over a 10-year deal. So you're seeing a lot of these big tech companies really double down on sports, where Netflix has taken a slightly different approach. We saw them debut the Netflix Cup, which was that live celebrity golf tournament. I'm sure we're going to see them dabble in a lot more live events moving forward. That's certainly been the vibe on Wall Street after this WWE deal. That's their lane. That's where they want to stay in, the entertainment of sports. But analysts across the board have told me that they're not going to be able to stay in that lane forever, that eventually they're going to have to pay up for those pricey sports contracts, because that's really the last frontier of the streaming wars, especially as the cable bundle really deteriorates.
It's true. I would say WWE may be sports adjacent.
Exactly.
I don't know if I can call it sports, but close to it. Now, of course, other news coming out, Netflix alluding to some changes to its pricing plans this year again. So what impact might that have?
Yes, basically, if you're in any market where the ad-supported tier is offered, don't expect to continue to be on that basic ad-free plan. That is their cheapest ad-free plan. They have said consistently that they're going to be phasing that out, and they confirmed that in the earnings release yesterday, saying that they're going to completely eradicate that basic ad-free plan. And the reason for that is simple. They really want to drive consumers over to their ad tier, which has consistently shown pretty good momentum over the past year. They said that ad tier memberships increased by nearly 70% quarter over quarter, and now accounts for 40% of all Netflix signups in the markets that it's offered in. Now, management has said that they're still in a slow growth phase there, and it's going to take several years before they can really see the impact of the ad business, until they can really have it be material to their general business moving forward. There's certainly a lot of competition in the ad-supported space. Amazon is going to be rolling out its own ads. That's going to be the default for Amazon Prime Video beginning January 29th. Netflix did address that. They said, you know, there's a lot of opportunity here, and there could be multiple players, but that they need to make sure they have the best quality product out there and really the best content to ensure that they're bringing as many subscribers onto that plan as possible. So something to keep track of moving forward, but that's certainly a catalyst for the stock over the next few years.
Yeah, Allie, still can't get myself to sit through ads, but
I pay for it. It's not that bad. It's not that bad, Akiko. I do the Netflix ad plan.
All right, maybe I'll consider switching. Allie Cannell is always staying on top of all the streaming news there for us. Thanks so much. Well, in the first 2 weeks of 2024, the global ETF market saw net outflows of $1.1 billion, according to data from Bank of America. There could still be some more opportunities in the ETF space this year, though. Here to talk about how to navigate the changes in the market as part of our ETF report brought to you by Invesco QQQ, we've got Daniel Soderoff, Morningstar Senior Manager Research Analyst, to discuss more. So give me the overarching headline here in the ETF space. What should investors be watching?
Well, you just kind of alluded to 1 billion. You know, that's small potatoes in the ETF markets. I think we see hundreds of billions of dollars flowing in and out of ETFs every year. So first couple of weeks of, you know, it's early days right now. I fully expect this is going to turn around as we get more into the year.
And so, Daniel, with that in mind, obviously preparing for potential rate cuts at some point in the year then. So what does that mean in terms of the best positioned ETFs, if you had to pick your top three?
So if I had to pick my top three, first one here, you know, you're talking interest rates. So let's talk about bond funds, right? Bonds tend to benefit when interest rates go down. So Vanguard Core Bond ETF, brand new one from Vanguard. It was just launched in December. We think that's a great idea. It's an alternative, I would really say, to Vanguard Total Bond Market ETF that trades under the ticker BND, managed by Vanguard's in-house fixed income managers. They're already kind of running the same strategy in a mutual fund format right now. So nothing that new. I think the thing thing you expect with this is it's going to be very index-like with the opportunity for some advantages around the edges. Really what they're going to be doing is tilting towards stuff with a little bit more credit risk. So investment grade bonds with sort of those lower credit tiers at the end of the day. And really what you should expect with that is maybe a little bit higher yield, a little bit higher return over the long run with this one. And in typical Vanguard fashion, very diversified, very cheap at the end of the day. So a great core bond fund for a lot of investors out there.
Daniel, what about growth names? I mean, the expectation here is that if these rate cuts, depending on how many rate cuts we get this year, if that does sort of accelerate or materialize, that this could be an opportunity to get back into some of those growth names. How do investors look at that, or how do people play that?
That's a possibility. I've heard the story before where a lot of people try to link interest rates to growth stocks, and whenever you start playing those short-term games, I think it becomes really kind of fuzzy, and the narrative's kind of there, but it hasn't really held up. It's kind of held up sometimes, it hasn't held up another. So you start to get into sort of these speculative, sort of situations like that. The truth of the matter is we don't really know. If you're into growth names, there's some great growth ETFs out there. Vanguard Growth ETF, which trades under the ticker VUG, is a great option. The other thing you could do is just use like an S&P 500 tracker or just a broader stock market ETF, so Vanguard Total Stock Market like VTI. Reason being is that the growth names are some of the biggest stocks in those index. So you're getting that plus with a lot of other stuff like that as well. So if you want to stay diversified, if you kind of want to tilt toward those to take advantage of what happens, or maybe you want to stay diversified and benefit from other stuff that may be doing a broader stock market index is a great play at the end of the day.
And Daniel, I'm looking at DFAW, another ticker that you're looking at, and you say that it mimics the mutual fund that they've already offered. What would be the biggest benefit then going this ETF route rather than just going with the traditional mutual fund route?
Oh, it's all about taxes at the end of the day. The ETF structure is just massively more tax efficient. So we're talking about Dimensional World Equity ETF. Dimensional launched this in September. And like you alluded to, it's basically an ETF version of the mutual fund that they already offer. So this covers the entire global stock market. Really think of it as like a one-stop shop for a diversified global stock fund. This could reasonably be the only stock ETF that you hold. It's one of the most diversified ETFs that U.S. investors can buy, period, full stop. Like the entire portfolio represents thousands of stocks underneath it. The one thing to keep in mind here, you got a little bit of a bias toward U.S. stocks, but I think that's kind of in keeping with the way a lot of U.S. investors kind of already invest. So you got about 70% U.S. stocks, 30% foreign. So still globally diversified, a little bit of a U.S. bias in it. And it's, sort of like along the lines of Vanguard, very diversified, but it's also very cheap. It's one of the cheapest in the global stock category that you could get right now. So another great long-term investment, I think, for a lot of investors, for the right investors out there, I would say.
And Daniel, finally have to ask you about spot Bitcoin ETFs. No surprise, been a bit of a choppy trade. We haven't seen the big upside to Bitcoin that maybe some had expected, although we're still a few weeks in here. How do investors trade on that? What are you telling clients?
So the big thing to keep in mind here is that an ETF doesn't really justify Bitcoin or change what it really is, right? You're still getting Bitcoin at the end of the day and still very volatile. And like you mentioned, I don't know the exact number. I've seen it down like 14, 15% since the ETF started trading. The big thing here is that it's a positive takeaway for anybody that wanted access to Bitcoin through an ETF. Maybe you didn't want to go to an exchange and do the digital wallet thing. This is another option for you. All of the ETFs are essentially offering the same thing. So I think the way we're pointing clients to is, go with the biggest ones. Those are probably the ones that are going to stick around, and then pay attention to fees at the end of the day. Fortunately, iShares and Fidelity kind of have it locked up. They're some of the cheapest ones out there. They've got the biggest flows. They've got the biggest AUM. Those are probably the big confidence bets in this space. And then below that, you got Bitwise and ARK that look like they're probably going to be around for a little while, but stick to the bigger ones in this case, I think is the safer bet.
It's true. And hey, if you're not into Bitcoin volatility, that's not the ETF for you. Appreciate you taking the time to join us this morning. Daniel Sotteroff, Morningstar Senior Manager, Research Analyst. Appreciate you taking the time.
Oh, you're very welcome. Thank you, guys.
All right. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
From its subscription concept to the rise of streaming, Netflix has built itself into a force in the entertainment industry. The company generated over $32 billion in revenue in 2023, including over 247 million subscribers worldwide. Beyond the Ticker takes a deep dive into the company's biggest moments. In 1997, Mark Randolph and Reed Hastings founded Netflix in Scotts Valley, California. 3 years later, Netflix launched its monthly subscription concept. DVD rentals were mailed to customers, along with prepaid return envelopes. Later that year, Netflix was almost sold to Blockbuster for $50 million, but Blockbuster declined the offer. In 2002, Netflix launched its IPO, selling 5.5 million shares at $15 each. It brought in $82.5 million. 5 years later, Netflix announced that it would debut streaming video while retaining its DVD rental service. Netflix stock fell to around $9 per share in November 2011 after the company revealed that it lost 800,000 subscribers in its third quarter. 2 years later, Netflix released House of Cards, the beginning of Netflix's original programming. In 2015, Netflix shares surged to an all-time high, over $100 per share. That was growth of 574% over the prior 5 years. In 2017, a study by PwC showed that the Netflix subscriber base was now equal to the number of cable TV subscribers, 73% of all U.S. households. 4 years later, Netflix launched its gaming platform Netflix Games, available on Android with 5 games at launch. The company also announced plans to expand its gaming service to iOS. In 2023, Netflix announced the wind down of DVD.com with its last shipment on September 29.
Well, potential showdown between former President Trump and President Biden comes to the forefront. The election is putting about $6 trillion in taxes in focus. Republicans are pushing to keep tax cuts from 2017, but no other specific tax plans from the former president yet. The Biden administration is looking to extend some of Trump's tax cuts, but companies and high-income households would face higher taxes under his second term. Taxes may look a little different next year, depending on the administration. But for this year, there are some guaranteed ways to get a bigger benefit from the season. But for more on the upcoming tax season, what filers can expect this year, we've got Mark Sieber, Jackson Hewitt, Chief Tax Information Officer. Mark, walk us through the key changes, first of all, that taxpayers, filers should be aware of.
Well, there were a lot of changes in 2023, even though it was a little bit slower than the prior two pandemic years. I would start off by saying there were some legislative and inflationary adjustments. The standard deduction is bigger. The rate brackets were adjusted down. The earned income credits up. There were some green credits put into place towards the end of the year. So if you bought an alternative fuel vehicle during 2023, be sure to tell your pro about that. If you did any home improvements to help the energy efficiency of your home, some credits there as well. But bigger than tax changes this year and every year are those life changes. I always tell people to look past the tax changes, the headline changes, for those life changes that might not be as sexy and might not be front page. Got married, got divorced, adopted or fostered a child or had a child, started a side gig activity, crypto, started taking care of dependent elder parents. All of those have a dramatic impact on your tax return, and mostly to the good, and sometimes get overlooked, especially if you're doing it yourself and rushing through your tax prep.
And Mark, we know that people can go into panic mode when it comes to taxes. If you feel that deadline breathing down your neck, talk about some of the most costly mistakes that you see people make that's really could be losing them out of thousands of dollars if they file incorrectly or perhaps miss some things.
Well, that falls into a dozen different buckets of mistakes. The number one mistake that I see, and I see it every year, is the mistake of omission. If you leave off a credit, if you leave off a deduction on your small business or self-employed return, 1 in 5 taxpayers forget to take or do not take the earned income credit every year, a credit that's worth upwards of $6,000. And here's the thing for your viewers. If you leave off a tax benefit, the IRS is not in the scrub it and look and make sure you get bigger money than send you a check later. If you leave it off, it stays off. So either get help or do the legwork yourself to make sure you understand all those issues, and don't rely on Uncle Bob and his internet tax knowledge. Have a pro, even if you do it yourself, to check on a fact or verify a myth or something that you hear.
And I did want to ask you about side hustles. Oh, sorry, I was going to ask you, because you mentioned some of the side hustles, and obviously for some people, they took on these side hustles because they couldn't keep up with the cost of living and inflation. What do they need to know about how they file?
Well, the side hustle business has certainly continued on after the pandemic. I think the last time I saw one of the FCC estimates, it's near 40 million Americans have some full or part-time gig. And I'll simply say it this way. Those returns are a little bit more complicated. Those rules are a little bit more complicated. Some credits, some deductions, some options. But here's the thing. There's no more lucrative set of tax rules than there are for small business, big business too, but especially for the small business. They can take deductions, they can write off expenses. And if you forget or don't know or leave that off, you're just cheating yourself out of money. So if you're not ready to do the work to make sure you understand all the deductions that you get associated with your business, whether it's the home office or mileage or computer charges, make sure you get a pro to help you or do it or look it over for you. It's a smarter investment of your time and money.
Bottom line, though, Mark, most Americans looking for a bigger tax return, right? I mean, that's sort of what it comes down to at the end of the day. 2 keys to doing that.
Well, the first key is don't do it at the last minute. File early. 100 million taxpayers get about $300 billion in tax refunds during season. I don't know why we have such a bad reputation, but the point is simply this. If you get panicky and you do it at the last minute, then you may be rushing. Then you may not have that documentation or that expense that you need to put on your return. Do it early, get your money early. Do it early and lock up your data with the IRS so some schemer or scammer, and those are out there, can't steal your data. File early, even if you're going to owe, you still don't have to pay until April 15th, and you lock up your data. And the number one reason to file early is that if you need more time, you have more time. You need to go find out your expenses, your home office deduction, the information related to that new dependent or that side gig expense. You have more time, you're not in a panic, and you don't shortchange yourself.
Now's the time to do it. Bottom line. Mark Sieber, Jackson Hewitt, Chief Tax Information Officer. Appreciate the tips today. Thanks so much for joining us.
Go get your money.
Well, coming up, the Super Bowl is more than 2 weeks away, but we're already getting a sneak peek at some of the commercials. We'll talk the trends we can expect to see in these highly anticipated ads. That's next.
From iPhones and iPads to Macs, Apple Watches, and AirPods, Apple's products are a daily necessity for millions, and the numbers prove it. The company generated more than $394 billion in revenue in 2022 alone. But how were they able to achieve such staggering success? Beyond the Ticker charts its path to becoming a tech giant. Steve Jobs and Steve Wozniak founded Apple in Los Altos, California in 1976. That same year, Wozniak built the company's first product, the Apple I. Apple debuted the Macintosh with its now iconic 1984 commercial during Super Bowl XVIII. The Macintosh stood out because it was the first mass-market personal computer to feature a graphical user interface and mouse. Jobs left Apple after his famous falling out with CEO John Sculley in 1985 and subsequently founded the Next computer company. In 1991, Apple introduced the PowerBook line, which set the standard for most modern laptops. In 1996, after a run of CEOs, Jobs returned to Apple. The company purchased Next to use its operating system and named Jobs interim CEO in 1997. Apple introduced the iMac in '98, and the line would go on to sell millions of units. 3 years later, Apple debuted its first iPod, which could store roughly 1,000 songs. And that same year, the company opened its first Apple stores. But it was in 2007 that Apple unveiled its most important product of all, the iPhone. A revolutionary device, the iPhone helped create an entire business model around apps and the App Store. Jobs suffered from pancreatic cancer towards the end of his second term as CEO. He resigned from the company just before his death, and Tim Cook took over as CEO in 2011. In 2015, Apple took the wraps off of its first new device since Cook took over as head of Apple, the Apple Watch. Just 7 years later, Apple became the world's first publicly traded company to reach a market cap of $3 trillion. And in June 2023, the company unveiled its most ambitious product yet, the Vision Pro. A mixed reality headset, the Vision Pro is scheduled to launch in early 2024.
Well, the big game is just over 2 weeks away, and CBS, the network hosting the event this year, has already sold all of its ad slots. A 30-second ad cost companies about $7 million in 2023, and the price is expected to stay in that range or push even higher. Let's bring in Marcus Collins, marketing professor at the University of Michigan and best-selling author of For the Culture. Marcus, always good to have you on. I was trying to do the math in my head. $7 million for 30 seconds. How much that breaks down per second. Is the return still there for these brands?
You know, it's an expensive endeavor, but I think it depends on what success looks like. Depending on what you deem successful, these ads can be quite beneficial. If this is about having cultural relevance, this is about being a part of the discourse, this is about just actually signaling creative excellence to get better recruits, to get better talent, to get better creative work from your agencies. There's a lot of value to them. I don't think that Super Bowl ads typically turn into commerce right away, but they have such a gravitas to our daily lives and our cultural behaviors that they can be very beneficial, but it is costly.
So clearly this is very, as you mentioned, expensive messaging that comes out during the Super Bowl. Talk about some of the biggest names that we're going to see and really some of the ones that are missing. We still remember, of course, when it was the year of crypto ads everywhere. How is this year going to be different?
Yeah. So I think there are a couple of things at play. There's some things you're going to count on. There's going to be big celebrities, big names, and that's going to be a mainstay. We expect that of the Super Bowl. There's some people that we typically look for, some brands that are normally a part of the Super Bowl, like Doritos, typically a big player. Tide had a big year a few years ago with It's a Tide ad when they were conquesting other ads that they had partnered with within the Procter & Gamble portfolio. Like I said, last year, lots of talk about crypto. Why is that? Because crypto was kind of very much a part of the cultural discourse at the time. I think the idea is that advertising, like most ads, but advertising during the Super Bowl, they are signals of what is culturally relevant today, because good advertising actually acts as cultural product, actually acts as cultural production. They're not just talking about the value propositions of the product, but they're signaling about what is normal for people like us. So expect a lot of celebrities, expect a lot of music. I would expect a lot of fun. You're probably not going to get a lot of, sappy sort of manifestos, like social commentary. There's going to be lighthearted fun using big names, using kind of jokes that we know they're going to go over well because of what is normal. And some of those returning brands are going to be the tentpoles of what we expect during the games.
Marcus, where does artificial intelligence, the conversation around AI, fit into all of this? Are we going to hear a lot of mentions of that?
Oh yeah, I think you're going to see AI probably as the butt of jokes. Not necessarily. I don't plan to see OpenAI doing a spot, because I think the difference between AI and crypto is that last year crypto was trying to become legitimate. They're trying to become normal, to become acceptable. AI is already being used. AI is already a part of our cultural acts as a society. And the difference now is us trying to decide what it means for us, not whether or not we're going to use it. So crypto as a technology versus AI as a technology have two different problems. But I think you're going to see a lot of play on AI, like, is it real? And that being sort of the nod and the wink of the foil of some of the stories you're going to see happening during the big game.
And Marcus, for some of these companies that already sort of preload the ads, you already see them. Why do that? What is the benefit of doing that versus having them appear like actually during the Super Bowl?
Yeah, bang for your buck. Instead of betting the farm on 30 seconds, I'm going to play it early. I'm going to play it early so I can get more mileage out of that investment. And the savvy ones use that as a setup for the future. So they're not baking everything on a small window of time where, though you have a captivated audience, there's so much attack on their attention that they play the spots early. In fact, some brands actually play their spots before the Super Bowl, which is a wise play on a media investment. It's cheaper to play your ad an hour before the Super Bowl and say, this is our Super Bowl spot, and sort of frame it as such. But these sort of savvy ways of getting more value out of the media is a smart way to go.
That's true. Certainly reduce some of those costs there. Office linebacker, still my favorite Super Bowl ad. Still sticks in my memory. Appreciate you joining us this morning. Marcus Collins, marketing professor at the University of Michigan and best-selling author of For the Culture. Thank you so much.
Thank you so much.
All right, well, let's get you a final check of the markets as we head into the noon hour. Looking at solid green across the board here. All three major indices hitting solid highs here. The Dow currently up 126 points, or 1/3%. S&P 500 also charging ahead, up 0.7%, or about 33 points. Tech-heavy NASDAQ leading the charge, leading this rally up over 1% so far this morning, or 165 points. Well, that does it for now. I'm Rochelle Akupo alongside Akiko Fujita. Stay with us on Yahoo Finance.